All right, yo, what's up for everyone on the YouTube replay? I hope you're having a great day. Let me start this stream off with a quick portfolio update. Then I'll get into some of the stocks that I think are at pretty good valuations to buy right now. There's a lot of stocks that are, at crazy all-time highs that just aren't buyable, but there are stocks out there that I do think have pretty attractive valuations currently. So let me start this off with a quick portfolio update, and then we'll look at y'all stocks too. So here's my dividend-only portfolio where every stock in here pays a dividend. Over the past year, we're actually up 20%, not too shabby. If we compare that to the S&P 500 the past year, they are up 13%, so we've done slightly better. But here's my total percent change on every stock. So luckily, we are green on every holding in here. McDonald's and Google are close to all-time highs. Meta's been not performing too well. I'm actually thinking about buying more Meta because Meta's legit at like a 22 forward PE. It's one of the cheapest and qualitiest names out there right now. So I also have a Roth IRA, which isn't doing too well. We're down 4% year to date. We've had this for basically exactly a year. And so we're down 3% all time. And here are all the stocks that we own in here if you're curious. I love this first stock up here, HCA Healthcare. Largest hospital, non-government hospital group in the U.S. and the world. So I love this company. They just print money and do so much share buybacks. Oh, and I also recently just bought one more share of InnoData right here. They just got a huge contract with the federal government for a Golden Dome contract, and they also got a huge contract with with Palantir. They got a huge deal with Palantir, so they're going to get a portion of Palantir's government contract revenue, which is pretty cool. Take a sip of my tea here. So yeah, that's my Robinhood portfolio. I'll go kind of quick here so I don't waste any of your time. So yeah, here's my Webull account. Hasn't done too well. It's kind of like my risk on portfolio. If you look at our open profit and loss in the top left, we're only up 6.9% all time. So it's not like we've, outperformed the market by some crazy amount. Matter of fact, we've underperformed the market. We've had some losers in here, and we've also had some losers that have completely sold. Well, just one of them, ChargePoint. I lost like $1,000 on ChargePoint. So here are all the stocks that we own in here. It's kind of just like I don't really have any rule. I kind of just do whatever I want. Like I got Reddit, Robinhood, SoFi, AMD, Disney, Iron Mountain. That's been a great REIT. That's a real estate investment trust. AbbVie is a healthcare play. Nice 3% yield on AbbVie. Progressive, we're down on Sprouts Farmers Market. Sprouts Farmers Market is just being out innovated by like a Walmart and Amazon. Whole Foods. And then finally, this is my favorite portfolio. This is pretty nuts. This is, we have a goal with these portfolio. This is my dividend only portfolio where I only buy dividend stocks. That's my risk on portfolio. Well, in this one, I have a rule where once I buy a stock in here, I'm never allowed to sell it. So I have to diamond hand these stocks. So yeah, we're actually up 34% year to date or 10 grand, which is just insane. Like I literally can't believe it. All those gains have most of them have come from Comfort Systems right here, which just hit a crazy all-time high on Friday. This is a huge beneficiary of the major CapEx spend of the Mag 7 and Micron and all these, nifty 50 names. Powell Industries has been phenomenal. Coca-Cola Consolidated, the defense name, just hit an all-time high on Friday. McDonald's and Coca-Cola, they're at all-time highs right now. It's pretty insane. And my recent purchase, which I just loaded the boat on, I bought like $1,400 in them. Every time I buy a stock, you can see like my buy order, spend 1,400 schmeckles buying some more Amazon because they're so cheap. I can't believe this. Just at a quick valuation basis on the right here, Amazon trades at 26 times next year's net income. I mean, it just seems so fair. So that's why I've been loading the boat on Amazon, really meaningfully bottom. Yeah, that line at the bottom, this like dark yellowish line is my cost basis line. So we're just barely up on Amazon. But I think they're one of the best stocks to buy and never sell. They're actually the number one Fortune 500 company now. They just took over Walmart for the most amount of revenue of any company that exists. Oh yeah, look at this. Top news. Amazon surpasses Walmart as world's largest company by annual revenue. And that's why Amazon is such a great growth behemoth. If we just look at the revenue right here, just this quarter, just this 3 months, Amazon did 213 billion. If we just zoom out on the trend here, this is why, it's not like, here's the thing. Amazon stock is falling because of the sentiment around them. They're not falling because of some huge miss on their earnings. Like the earnings look phenomenal. Revenues at a record, and here's their net income and their profits. The profits are at a record on the right there. So the revenues at a record, their profits are at a record. They're expanding margins, but it's how much they're spending. So the free cash flow is down because they're spending all their cash. Instead of just keeping it as cash, they're investing it all into the future. And that's my favorite part about Amazon. They out innovate all their competitors. You don't want to compete with Amazon. The day Amazon announced they're expanding their same day grocery delivery business to over 1,000 new cities, Instacart stock fell 15%. So there's just when they got into like this other one, like Blue Apron stock fell 50%. Like it's crazy. So anyway, Amazon's an ETF in one, a cloud play, grocery store play, AI play. They own 15% of a Claude, which is, or Anthropic, I mean. Hey, what up? I hope everyone's having a great Sunday. Good to see you, Mike and Deborah, Maddie, Pontus, Counting P. What's up, man? Remember a month I told you about Zim? Yeah, I think they just got acquired or something. This is that shipping company. They're kind of like a dividend play, but they just got bought out by some company. Yeah, so I think there's no more upside because they're buying them out at basically like a 3.6 billion market cap. So congrats if you own that one, but they're getting taken off the market. Now I actually have a better suggestion, and I made a video about this stock down here. I was making a lot of stuff about this. So if you like Zim as a shipping business, and what I mean is they just do this overseas freight. I'll kind of show you their website. They do the exact same thing Zim does, and I think it's a much better buy in my opinion. So yeah, check this out right here. Let me show you why I like ticker symbol GSL. So they do the same thing, freight, and here's their net income. Yeah, check this out. The profits are so consistent. If we look at Zim in 2022 and 3, they had negative net income for the whole year, but then it spiked back up. But this company just makes consistent net income easily, like 90 to 100 million a quarter. And check this out. This is the crazy part why everyone likes this one is because of the dividend yield. Most companies you see out there, they have a crazy 5% dividend yield. It's usually like unsustainable, but with this company, they're actually unique because it's very sustainable. I'll show you exactly how much that 5% dividend yield costs. So here's their net income, easily making, we'll call it 90 million, 95 million net income a quarter. And check this out. We can go see how much exactly the dividend costs. The dividend cost every quarter, again, they make 95 million and the dividend cost every quarter 21 million. So of course they can easily afford it. There's only like a 20% payout ratio. So that's what's pretty cool. So it's one of the higher yielding names that I like. And you don't just get a high yield, you also get decent stock price appreciation. They're actually at an all-time high right here. So actually I regret when I was pitching this one a while back, I actually regret not buying them. But yeah, congrats if you own that one. All right. Someone says, can you analyze Leonardo? Hey, I have no clue what you're talking about there. Hey, what's up, man? If you have a stock you want me to look at, give me a ticker symbol because I've never heard of that. But yeah, try not to spam too. Hey, what up? Let's see here. Let's do Moody's. Warren Buffett's what up, Deborah? Let's do Moody's. Warren Buffett's a big shareholder here. You know what? Let me pull up Warren Buffett's portfolio. Where is Moody's in his portfolio? So yeah, it's actually 4% of his portfolio. Now Google is 2%. This is his recent purchase. He bought Google, but here's Moody's right here. They have this huge credit rating business. They have a shared oligopoly with Fitch and S&P Global for rating debt. So credit ratings. Let's see revenue right here. So Moody's Investor Services, Moody's Analytics. So yeah, they do what S&P Global does. And they print money. Check this out. If we just go to their net income right here, easily, and it just grows over time. I guess it's kind of flat from maybe that's a one-time adjustment though. Let's see. Yeah, the profits are, trending up. So yeah, they really do make, we'll call it 500 plus million of after-tax net income a quarter. So they're easily making over 500 million net income a quarter, and you get a near 1% dividend. It's just like a quality name. I think, or what's the valuation? So a 29 forward PE, that still might be a slight bit expensive, but for a monopoly that they have, they certainly deserve a high multiple. They're a very quality name. Buffett owns them. So US is 54% of the revenue. And it's good. Yeah, here's Berkshire Hathaway. Berkshire Hathaway owns 14% of the entire company. So pretty cool. All right. Maddie said, Tomorrow I am buying TTE stock. All right, let's check it out. Total Energy. So actually this company is close to an well, they're lower than they were in 2007. So what's the dividend? But if we look at them just the past couple years, they're at a multi-year high, a 5-year high right now. And you get a 5% dividend yield, so not too shabby there. Let's see what they do. So they're like a commodity, maybe oil and gas. So exploration and production, LNG, refining and chemicals. So let's see what the revenue is. So the stock's at an all-time high. They must have had some good numbers here. So the revenue did fall year over year. So the revenue's down 2.5% after it fell 14, after it fell 14. So it's a cyclical commodity business, but oil, like if you look at an ExxonMobil or like a Chevron, they're at all-time highs right now. So that's probably why this one's at all-time highs right now too, following that same success. So yeah, even though the revenue's down, which isn't a great sign, all the oil and gas stocks revenue's down, but this is the best part. Look at their bottom line. They easily make like $3 billion net income a quarter. So that's how they can afford that 5% dividend. It says they have a 66% payout ratio. Nice. So yeah, that's why they trade at like this commodity 11 PE, because they're an oil and gas stock. So nice. I don't, that won't outperform the tech heavy S&P 500, but you buy it for that defense and the dividend. All right, let's look at some more here. LDO stock. What's LDO? Let's see. Wait, what was that? Um, I don't know. I can't find. Let me know which one. Is it called Lido DAO? I can't find that company. If it's some like overseas or ADR company, I don't know if I'm going to be able to find that one, unfortunately. Or KOG. What's KOG? Yeah, I typed in KOG too. I see KO Gold. Let me know if you're talking about KO Gold. All right. JX or AXJ said Circle Stock. Yeah, this is your stablecoin play. They actually have like a 40% stablecoin market share. So if you've heard of USDC, this is the stablecoin issuer for that. It's kind of a unique crypto play, and they're actually very cheap. Well, not very cheap, but I love the profits on this company. Let's see if there's any kind of news. Continue strong growth driven by the USDC stablecoin. Okay, well, let's see if there's any specific news. Then we'll look at their numbers right here. So, nope, no news. Okay, so they report earnings on the 25th. So, they report earnings in 3 days. So if you buy the stock now, it's kind of like you're betting on earnings. So, I guess we'll see what the earnings are. We can see what the earnings expectations are. So next quarter they're supposed to make 40 million and then 47 million. So yeah, they had their IPO one-time fee this quarter, one-time adjustment. Basically, we should look at the EBIT right here. They're going to be making like 50 mil a quarter, which is we'll call it 250 mil in net income a year. So yeah, they are a bit expensive. Let me do some 14.8 divided by 0.25. All right, let's see. So a 60 forward PE, and let's say it's a 73 forward PE. So they are a little bit expensive, but I do really like them. It's your stablecoin play for USDC. So let's see. Next up, we got yo, what's up, agent? You do a great job. Hey, appreciate that. Thoughts on SIRI? I think Warren Buffett bought more of this stock. I don't think this one's too quality. Like if we just think about what the actual business is, this one, I'm not too fond of buying and holding this one for the long run. So this is SiriusXM. It's kind of like that radio company. Like, yeah, SiriusXM and Pandora and off platform. So if we go to their revenue right here, it's kind of like slowly declining. Like this just isn't really what you want to see. For the past couple of years, the revenue's been flat, and now it's kind of like slightly going down a couple percent every year. But the good news is they still make money every quarter. Ooh, let me go to the operating profit. So yeah, here's their before tax number. The after tax number looks a little wonky. I think they had a one-time adjustment, but usually we'll call it, they're making like 230 million after tax a quarter. They do have a high dividend. So yeah, 5% dividend. Let's go see if it is safe. So if they're making 230 mil in net income a quarter on average, the dividend actually says the dividend only costs 45 million. I wonder if they like, well, I guess this says the payout ratio is a 48%, because the valuation is probably really, really low. Yeah, so they're trading at 6 times forward net income. So just a very cheap, like at a valuation where they're not really expected to create or lose you any value, commodity multiple. I guess just because the long-term thesis around this one just isn't good. Like, there's just no future growth for this one. Like, it's just the revenue's probably just gonna slowly go down single digits for the rest of the time. What was your thesis when buying Powell? Hey, I actually have a video deep diving in, like, the day after I bought it. I have a huge video, but basically this company, the one I bought it, they were worth $900 million. They had no debt, 300 million in cash, and making 100 million in net income a year. So I'm like, this is a steal of a deal. And when I bought it, I didn't feel great about buying it because it looked like it was really expensive. After this whole rally, I bought Powell Industries right there at $79 after it already had gapped up 3 quarters in a row. But then it just continued its successful momentum. I can't believe it. And now the fundamentals are even better. So, yeah. Let's see here. Oh, yeah, I saw someone ask about that. All right. Let's see what we should analyze next. Is it not gonna let me? Okay. SoFi Bank, please. Yeah, SoFi is technically a bank. They do have a banking charter, which is pretty cool. They got it through a loophole that's now like patched because of them. They're like impossible to get. So what I love about SoFi is how growthy they are. I am a shareholder of SoFi, so I might be biased when I go over them, but I own them for a reason, and that's because the fundamentals look so great here. If you go to their financial services right here, this is the main metric you want to look at on SoFi, and this growth has just beat all expectations. It's up 76% year over year. Like, if you just look at these middle growth rates, it's so impressive. No analyst expected this. And we can see what the analyst expected. That's the orange line right here for the past 3 quarters in a row. They just beat on revenue and beat on net income every quarter. And the analyst expectation, like, is only up and to the right. Like, they're supposed to make 200 million in 2 quarters. So that's why I think people are really taking SoFi very seriously, because the growth is there. The fundamentals are great. Revenue's growing, net income's growing, making 100 mil a quarter. But what's the valuation right now? I think they're finally at a good, 28 forward PE. I think that's very fair for the growth that they have. Like, if you look at their current PE on the left, they look super. Wait, sorry. If you look on the left, the PE looks expensive. Like, they're trading at 48 PE, but when we look at the forward PE, it's a 29. And I think that's super fair. So I would actually, not financial advice, like, if I wanted SoFi as 5% of my portfolio, I would not make it 5% today, but I'd probably go ahead and make it 1% today. And just because the growth is so good. It's a great growth name. So Mr. said PSTG. Yeah, this is like a subscription, like storage, just like data storage play. So check this out right here. The metric you look at, or I like to look at, is their subscription service revenue. I like it because it's like reoccurring revenue. This is what you want to see. It's up double digits every year, every quarter, up 15 after 21, after 24. So that's good to see. Then they also have their product revenue, which is up 17%. So both businesses are doing great. Are they beating on expectations? So they did beat on revenue, but they did miss slightly on net income this quarter. But anyway, the revenue growth is great. They're nearly at $1 billion of revenue. Yeah, that trend looks amazing. The revenue was a record this quarter. It's never been higher. So nearly $1 billion of revenue. And on that, so the profits did fall 10% year over year, technically. So that means there's a problem with their net margins. So it's like they just need to fix their margins, because the net income's still a little choppy. Sometimes they lose money, but yeah, so they still, because of that, they're at a 92 forward PE, because the net income is a little like up and down. So I would just be careful with this name. Nothing's really blowing me away here, because they're at this current price. I love the subscription revenue, but the profits are a little choppy here. Actually, I believe it or not, like back in 2022 or one, I owned this stock, but I don't anymore. Let's do what up, Zero? He said HMC stock. What's HMC? And then we'll do Microsoft. Anyone buying? Yeah, XYZ Steve. Yeah, dude. Me. Or well, I think it's a steal of a deal. Hey, let me know, Zero. Are you talking about HMC Capital, or HMC is Honda Motor? I think Google is about to buy like a bunch of cars for Waymo from them. You know what? We should. Oh, let me do Celsius. This is your energy drink play, and then we'll do Microsoft and some of these other names. What do you think about Dell? Yeah, Dell's a nice infrastructure play. I like them better than Super Microcomputer. They're like a value stock, actually. They're cheap. So here's Celsius right here. This is an energy drink play. They have like a 23% energy drink market share in the US. And when did they report earnings or did they, or no, so they haven't reported earnings yet, but I think they report soon. So anyway, what context is good to know is that they just acquired Alani. If anyone's heard of Alani before, it's like a popular energy drink. So that's why if we go to their cash investing activities, they bought that's the reason it's negative 1.3 billion because that's what they spent buying Alani, and that's why their balance sheet changed so dramatically, and that's why the revenue growth is also up triple digits. The revenue's up 172% year over year because they now own Alani and they also own Rockstar Beverage. So if we zoom out, that it's not all organic because it's part of the acquisition, but the revenue's at a record, and not just the revenue but the profits as well. On the right there, this quarter specifically, they did 166 mil before tax. Well, I'm looking at the before tax number, so just subtract like 15% like this. I don't look at the after tax number because they had a total one-time adjustment this quarter since the net income was negative 61 million. The good part is it wasn't. This was a total one-time termination cost from switching their bottler from some random warehouse to Pepsi, so they're going to the Pepsi network. So anyway, I actually really like Celsius. They are a little expensive at a 35 forward PE, but like this whole space is on fire. Like look at a boring Monster beverage. Like we've all heard of Monster. It's like that energy drink. Uh-oh. Sorry, I flipped it there. But yeah, here's Monster beverage. Crazy all-time high today. Or it was on Friday. So Monster's at an all-time high. I also own the Coca-Cola / Monster bottler, which is Coca-Cola Consolidated. They're also at an all-time high. So actually Coca-Cola's at an all-time high. Pepsi's close to an all-time high. A lot of these like staple names, like food names are. McDonald's is. So Nicolo said, oh, wait, let me do Microsoft real quick. So we'll do Microsoft because this is one of the best stocks like I'd recommend for any portfolio. It's a phenomenal backbone to any portfolio. And I think the risk reward is so fair. Like it's almost impossible in the long run to like lose money buying at this valuation. Like the risk reward is so good on Microsoft. Let me show you why. And first off is the valuation on the right. They literally trade at 22 times next year's net income. For the behemoth Microsoft, the ETF Microsoft, like that's insane. And part of it is because they're being included in this like a software sell-off because they have a big software business that's 42% of all their revenue. So, think of Excel, OneDrive, Office 365, PowerPoint. That's all this business right here. And that does over 120 billion of annual revenue for them. And it just continues to grow and hit a new record every year, every quarter. So that does over 120 billion of revenue a year. They also have this cloud business, the Azure cloud. That's up 28% year over year. And the revenue is 106 billion for the full year. So it's just incredible. And they print net income. This is the before tax number again, and another one-time adjustment they had. They didn't actually make 38 billion, but they're always making like 28 billion, and they actually made 30 bill this quarter when we subtract that one-time adjustment. So this company literally has prints money. 28 bill a quarter, better credit rating than the better credit rating from S&P Global than the US government. So, and they have this revenue sharing agreement with OpenAI. So OpenAI, if you look at it, it's the very top one at the very, very top right here. It says Microsoft extends OpenAI revenue share agreement to 2032, secures 20% of their total revenue and a 27% stake in OpenAI. Remember, OpenAI owns ChatGPT and all that. So pretty cool. Anthropic projects 80 billion cloud payments to Amazon, Google, and Microsoft. So yeah, huge cloud play. AI beneficiary too. LDOS, Italian defense stock, and KOJ's a Norwegian defense stock. Oh, hey, nice, man. LDO. Let's see if we can find that one. LD. Do you want me to look at LDOS stock? Let me know and I'll check it out for you. Or do you want me to go over one of those? I will. Oh, here's actually another like defense stock. This is Kratos. I actually really liked his name. They've had a lot of pricing power. They like negotiated higher prices with the U.S. government. Is there any news? Nope, no news. But let me show you what's pretty cool about the stock. They're really profitable, and they're also a drone play. Yeah, they have these unmanned systems business, which is their drone business. And check it out. It's actually pretty good growth. It's up 35% year over year. But the main winner's this government business, which 2 quarters ago is when they renegotiated. So we look at the revenue the past 3 quarters, the expectation. So the orange lines, what the analysts expected, this quarter they expected 322. They did 350. In the quarter before, they only expected 305 and they did 351. So great beats on revenue, a good beat on net income as well. They expected 5, they did 8. So it's a company where they're making net income every quarter. So they are making net income, 5 to 8 mil in net income a quarter. Revenue's up 25%, but they're just tremendously expensive. Yeah, like look at that forward PE, like Palantir type expensive at a dang 308 forward PE. So it's even on this dip, or they're kind of on a dip, like they're still really expensive even on the dip. But they do report earnings. What was that date? February 23rd. So tomorrow. Wow. So tomorrow they report earnings. That'll be very fun. Um, okay. What is these app? Hey, what up, Logan? App loving. App has been killing it with the operating margin. It's on the watch list. Yeah, this I've been talking about this stock a lot. This is one of my favorite stocks that have great fundamentals. Hey, yeah, we'll do Salesforce. What's up, LH? Sorry if I'm missing some stocks here. I'm reading both the YouTube and the TikTok chat. I'm getting all of them. So yeah, if you have a stock you want to look at, let me know in the chat. We'll try and get to all of them. But I'm sorry if I do miss a few. Don't spam, but feel free to like re-say the stock every time that's off the screen or something. But here's AppLovin. This is an incredible stock with incredible fundamentals at an incredibly cheap valuation, I think. If you look on the right, they're at 26 forward PE. I know a lot of stocks at a 26 forward PE, and this is one of the best ones. Because if we go to the net income right here, this is the best part. Actually, I should go to the revenue right here, which did technically have a one-time thing from last quarter. But anyway, the revenue was 1.66 billion. Out of this 1.66 billion of revenue, they kept the net income after paying taxes of 200 million. They kept 1.1 billion dollars of that. And if we just zoom out to the trend of this net income, and this is like real, this isn't some like one-time adjustment. Like this is their real after-tax net income they make. It was 1.1 billion this quarter at a record. That's like I can't put into words how impressive that growth is. And so that means their net margin is a 66%. Like, look at this net margin growth rate year over year. All year over year, insanely growthy, year over year comps to the net margin. So a 67% net margin. And we can see the net income expectations. They've beaten on net income projections the past 3 quarters in a row. And the expectations are up and to the right. So it's not going to stop. It's supposed to go to 1.25 billion in 2 quarters. Revenue is going to go from 1.25 to 1.88. So there's still going to be so much more growth. And that's why I think they're very deserving. Actually, I think this is cheap. I think they could stretch up easily. It's like a 30 forward PE, send this up another 15, 20%. So this is actually is one of my favorite stocks to put on the watch list and potentially buy now. Like Ash said, what's your favorite discounted stock to add at the moment? AppLovin would be on the list. Also, Microsoft's a steal. Microsoft's probably the best buy right now. Meta's great. Uber's really good. AppLovin. So, yeah. Yeah, those are incredible margins. So let's do Salesforce really quickly. This is one of the software names really getting hurt by the AI thesis. Let's see. Yeah, Salesforce trades at record low PE ratio as AI agent concerns trigger software sell-off. So, and they report earnings on the 25th. So in 3 days, they report earnings. So yeah, get ready for earnings report. That's kind of what you'll watch this week. Is there any news? Not much news. So yeah, they're about to report earnings, so we're about to get news on them. But anyway, they're very diversified in terms of where the revenue comes from, services, sales. And one of my favorite things about Salesforce was their Slack acquisition. They own Slack, like over half the S&P 500 uses Slack in so many businesses for like employee management. And that grew 20% year over year. After grew 9%, after grew 10. So the growth is back over there. Agent force integration and analytics, marketing. So if we go to their net income too, the net income's at a record. So we're at a thing where they're actually beating on their expectations. Like here's their net income every quarter. They beat on net income the past 3 quarters in a row, but the stock is at a multi-year low. Your Salesforce is below where they were before the pandemic in 2020. So they've just seen this massive sell-off. So they're trading at a dog cheap valuation. Yeah, if we go to the right, they're at a 24 forward PE. So, which is, yeah, the cheapest they've ever been at. But I mean, I am kind of scared of the software like thesis really hurting Salesforce. So that's why I am a fan of buying the dip, but I would keep it as like a very small position. Like I wouldn't want Salesforce as like a meaningful size position of my portfolio in this environment. But I think it might be worth slightly nibbling, but buy like a super small amount of it, but don't buy any more unless it falls 10%. And there's a chance it may not fall 10%. There's a very high likelihood that this could be like the bottom. Or like the risk to reward to buying Salesforce does look very good. But it's kind of like Adobe. I think this is a better buy than Adobe for sure. Yeah. And you get a dividend. They do share buybacks. Yeah, 0.9% dividend yield. They do M&A. They buy a bunch of companies too. Like they just bought INFA. So oh yeah, they're delisted now. But yeah, anyway, Salesforce is interesting. Yo, what up, Cruz and Looney? Shout out to member Looney. Hope you're having a great day. We have not done Walmart yet. Carlos said Teradyne. Yeah, this is a robotics play. Yeah, they've been on fire. They're at an all-time high. Whoa. That's insane, actually, that rally that they've had. So they gapped up on earnings day. Let's go look at what their earnings report was because it must have been incredible. Is there any news? Driven by AI-related semiconductor test demand. So semiconductor test demand, I guess that makes sense because of all the chips right now. So they do semiconductor tests, product tests. And yeah, then they have the small little robotics division. But yeah, it looks like they had a great beat on earnings. They beat on revenue. They beat on net income. Yeah, look at that beat. No wonder they're at an all-time high. Good beat on revenue, good beat on net income, rose guidance. And if we zoom out to the net income, I mean, yeah, that's the highest net income they've had in years just this quarter. So I can see why they've had all this momentum, but would I buy the stock today? Probably not. They do seem quite expensive at a 60 forward PE. It's definitely tough to buy them after they've had all that crazy rally, but they are interesting and definitely an AI beneficiary. Another cool robot. I don't know if that's really a robotics play or maybe it'd be, I don't know, what website you're using. Yeah, this is a broker I'm on. If you want to get this brokerage I'm on, it's in the link in my bio, that first link there. So brokerage. What's your take on NVIDIA, Salesforce, and Snowflake? So yeah, NVIDIA, a lot of people think NVIDIA is really expensive, but it's really not that expensive because all the CapEx of the other Mag 7 is crazy right now. This is the picks and shovels play of this whole AI craze. Is chips, and NVIDIA makes the chips, as you know, and they have a crazy market share, a 24% PC GPU market share. But the best part is the net income expectations. Already this quarter was a record net income. They did 32 billion of net income. Like that's an already crazy number. 32 billion in net income just this quarter. But if we zoom out, we can start to understand why NVIDIA stock has been so hyped up. It's not just going up because of momentum. It's going up because the actual fundamentals are going up. And it's not going to stop here. They did 31.9 bill of net income, after they paid 5+ bill of taxes. Net income next quarter is supposed to be 35.8 billion and then 38 billion the quarter after. If you kind of annualize that number, like 40 bill, that's 120 bill in net income a year. Like it's just insane the profits they're going to make. And so that's why if we go to their forward multiple, NVIDIA only trades right now at 28 times next year's net income. So it's kind of interesting. So it's a tough double. Here's the thing. NVIDIA's not the best buy ever because it's really hard to double, but I think you're going to get market returns, S&P 500 type returns of 8 to 10% of your money back a year. But if you look in the top right, NVIDIA's worth 4.6 trillion. So they're worth 4.6 trillion. For you to double your money, they have to be worth, nearly over $9 trillion of market cap. And it's just like law of large numbers. It's tough to double to 9 trillion. So I still think you'll get 8% of your money back a year, but it's, I like to buy the AI beneficiaries, kind of like a Comfort Systems, an Amphenol stock that supplies NVIDIA the copper cables for their NVLink products and their GPUs. Amphenol stock also supplies in Google fiber optics and copper cables for their TPUs. Constellation Energy has a nuclear play, providing clean energy, sustainable energy. United Rentals for their construction spend. So, all right. Thanks, but can you go deeper on LDO? Yeah, hey, J4, are you talking about LDOS stock? I tried to find that other stock you were talking about, Kongsberg. Or hey, let me know, is this the stock right here? I think you were talking about this stock right here. So this is an ADR aerospace and defense name, and all the aerospace and defense names have been doing phenomenal. So I'm pretty sure this is the stock you're talking about, Kongsberg. They're actually on my watch list. So yeah, we'll convert the currency from Norwegian to US dollars. Yeah, bet Jay. And my bad for taking so long. Thanks for being here. I appreciate you. It's just hard to find these ticker symbols sometimes because they're ADR. So yeah, check this out. 80% of the revenue is actually aerospace and defense. And look at that annual revenue. This is what you want to see for the full year 2025. It grew 49% from the full year 2024. I mean, we can just kind of see that the chart at the top here. It was a blowout record revenue quarter for them. And where does the revenue come from? Well, they're based in Norway, but yeah, a lot of the revenue comes from Europe, 31%, North America's 23%, Asia's 20, Norway 18, Australia. So it's a nice international aerospace and defense name. And check out their bottom line. This is quarterly. I love these year-over-year growth rates. And we've converted the currency again to US dollars. So this is USD. They're easily making like 200 million, well, close to 200 million in net income a quarter. And at this growth rate, like, look at that. Like this stock isn't just hyped up from momentum. Like the fundamentals really are growing very nicely. So yeah, there's your Kongsberg. Yeah, I see nothing wrong here. Stuff looks great. Numbers look great. Nice aerospace and defense name. Like a lot of if we just go to like an SHLD, this is just the aerospace and defense ETF. It's at an all-time high, like a Raytheon and a GE Aerospace. All right. Next up, investing said IoT stock. Let's do Samsara. And then, hey, Looney, do you want me to do Walmart stock? We have not looked at Walmart. And Simmons, Simmons Medical. I think you mean Simmons Electrical, but if there's a Simmons Medical, we'll check that out too. Hey, what up, Tommy? We'll look at Core Medics. Yeah, we're going to be live for easily another 2 hours. So sorry if I missed some stocks here. I want to get to all your stocks here. So, and I try and go quick, only spend a minute on each stock. So here's Samsara. Oh, and if you wanted the follow button, we stream every day. I sell nothing. I have no course book. I'm just on here to give my opinion. So here's Samsara. I forget, did a company just take a stake into this stock? I don't remember. Maybe that was a different stock I'm thinking of. But anyway, let's see what they do. What does this company actually do? So they're in software infrastructure, AI application software. So they're probably, they're a victim, of course, just like Salesforce, to this huge software sell-off. Because, if we look at their actual financials versus analyst expectations, they're doing everything right. They're actually beating on expectations. They beat on revenue for the past 3 quarters in a row. They beat on net income like crazy for the past 3 quarters in a row. They were expected to lose 18 million. But for the first time, this company actually made 7 million in net income. Look at that. So this is a cool thing. You're basically buying this company as they're getting profitable. So obviously the forward PE is going to look redonkulously expensive because they're just now getting net income positive. Yeah, they still have a negative forward PE. I actually think they should have a slight positive forward PE if they keep beating on expectations like this. Like they actually, like the net income narrowance is so impressive. And look at the revenue as well too. That deserves some attention. So there's a disconnect between the fundamentals and the stock price and the valuation. So that's why this one's actually pretty interesting. They're worth $15 billion. So it's, again, tough to value this one on a forward metric because they're just getting their first ever EPS. So, but it looks interesting for sure. That's a cool one. Let's do Zeta. I saw some people talking about Zeta. That's another software name. So another one of these software sell-off. And I think they report earnings on the 24th. So in 2 days. In 2 days, we get Zeta Global. So get ready. It's another software name that's beating on expectations. Is doing everything right, but it's just a victim of the software sell-off. I don't know much about them. Like, I wish I could tell you exactly what they do, but it's just some like enterprise software. And if we go to the revenue, like this is what you want to see. The revenue's at a record. Revenue's up, what was it, 25% year over year. After grew 42, after grew 25. So they're on a nice streak of growth, and it's not just the revenue that's growing, but also the profits. So they are still losing money, but it's kind of like that other company, IoT, where you're buying them right as they're getting net income positive. Like I bet you by the same time next year, they're actually going to be making net income every quarter because right now they're just barely losing any money. They're significantly narrowing the losses. So pretty cool. All right, that's Zeta Global. So another one where you can't really look at a forward PE because there is no forward PE because the EPS, they're just getting EPS positive. So that's just a risk to be aware of. Yeah, AppLovin with the 70% margins, it's nuts. So let's do really quick. Ooh, I'm so behind on the chat. I am so sorry. Um, Let me do SIEGY. Let me do Simmons, and then we'll do ARM. Oh, ARM is a royalty play. Yeah, hey, see, I'll try and do FIX. We just looked at SoFi a minute ago, so I'll try and get to SoFi if you remind me in like 10 minutes, just because we just looked at them a minute ago. But yeah, here's Simmons right here. The stock is pretty much at an all-time high just from the electrical infrastructure boom. As these new data centers, need all this electrical work. Actually, in my house right now, we have like an outside Simmons electrical box. So I guess we're a customer here, but they're not even expensive at a 22 forward PE. So that's pretty fair. They're only trading at 22 times forward net income. So Simmons, Healthineers, smart infrastructure, digital industries, mobility. So let's check out their net income right here and their revenue. So the revenue is growing nicely. Oh, wait, so we're going to convert the currency from European to US dollars just so we can see it in USD. So a net income, here it is. That's insane. They're easily making over 2 billion of net income a quarter. So they're easily printing 2 billion net income a quarter. They have a dividend. They also have a dividend. And look at that dividend growth. So no matter if you just buy the stock, no matter what, you're getting 2.2% of your money back just in a qualified dividend every year. A 22 forward PE. You get exposure to a bunch of different industries and geographical places like Germany and EU. China's 9% of sales. I like that it's not that high. So they beat on expectations. Check that out. Analysts expected 1.85. They did 2.35. So they had a nice beat on net income and revenue this quarter. Pretty cool. Let me actually check if there's any news on Simmons just to see. No, I'm not seeing any news. But let me get to ARM. This is a really interesting royalty stock, and I didn't even realize it was one. So this is like a chip play. They make these energy efficient chips that are even in like all the new iPhones now. So if we kind of zoom out, like just to break it down, like, yeah, check this out. Look at the gross margins of this company. ARM has 97% gross margins. Why is that? Because they just collect royalties as their main business. 59% of the revenue is their royalty revenue. And then their other half is their licensing revenue, which is all super high margins. So that's how they have that crazy high margin. Here's their net income. They're usually making like 200 mil in net income a quarter. So pretty good. No dividend on this one, but they're still expensive. This is one I'd love to own. I really would love to own ARM, but they're still expensive at 117 forward PE. Like even on this little dip, like they're still expensive. So next time there's a semiconductor sell-off, this is one of the ones at the top of my watch list I'm actually going to buy because I love that super high margin royalty income stream. And I love what they do. All right, Vive, let's do Vive. Yo, what up, UZG? Hope you're having a great day. Can you check AMD? Yo, I do actually own some AMD. Yeah, we'll try and get to AMD too. Kind of funny situation. I own an electrical company. I'm currently in Eaton. Yo, yeah, we'll do Eaton as well. Eaton is it's kind of similar to Simmons. You're right. It's like another electrical infrastructure play. They also have like 10% of the revenues like aerospace and defense. Actually, let's go over them. They're at an all-time high as well. Remind me. Because I'm behind. I got to get to Mike Grunstock and Tommy. If you're still in here, remind me to get to Cormedics and Take Two. Like, I'm just so behind. I'm so sorry, guys. So here's Viva Systems. First off, I appreciate everyone that's here. We're going to be live for another hour and 30 minutes easily. So here's Viva Systems. Let's see what they do. So they're a subscription company. I do like subscription model companies because it's all like reoccurring revenue. And check that out. That's what you want to see. Nice double-digit growth. It's up 17%. After grew 17. After grew 13. After grew 17. So it just hits a new record every year, every quarter. And let's see that kind of zoomed out. Yeah, that's incredible. So I'm assuming, yeah. So because it's a subscription software company, of course they're going to look just like a Salesforce, just like an Adobe, where all the software names just get tanked. So again, it's not falling because they're missing on earnings. Again, here's the earnings expectations. They actually beat on revenue for the past 3 quarters in a row, and they beat on EBIT. Dang, so they had a slight adjustment. Well, they beat on net income this quarter, and they beat on EBIT. So they're beating on net income, beating on revenue. They're just falling because of the sentiment around all the software names. Will Claude Code hurt them or whatever? Anthropic and OpenAI. Yeah, who knows? But if we just judge a company off their fundamentals, this one has really good fundamentals. And I'm a big fan of subscription model companies because of that reoccurring ARR. So, and it's very predictable. So yeah, here's the revenue. Let's see the profits. And look at the profits. I forgot. I didn't even look at the profits because I didn't think they were profitable. They're already profitable. Dang. So they're already making 200 mil plus a quarter. And at this growth rate, what's it going to be at the same time next year? So yeah, there's Aviva Systems for you. They're on my watch list. Yeah, actually at a 29 forward PE. What was that other software name we looked at? I might make like a software, like best software. Oh, it was IoT, I think. I think that's the one. I want to make a video specifically going over like the best software names on a dip, but where the fundamentals are, the long-term thesis might still be there. Let me get to Coremetics real quick. This is a cool one, but I do own this one, but I never recommend having this one as a meaningful size position because it's just so risky. But let me give you my thesis on this company. I am down 35% on them. They're one of my smallest positions. I do not recommend you have this as a meaningful size position in your portfolio. Like, don't make it over 2% of your portfolio. Like, you make it 1 or 2% of your portfolio, and then you just let it grow into a meaningful size position. So there's some of my buy orders. Usually I have been buying a little bit more Coremetics. So if you look at the top right, the market cap, this whole company is worth $553 million. Out of all the companies worth $553 million, I want to buy the company that's making this profit. This quarter, they made 51 mil. Like, that's already a huge chunk of their market cap. They made 51 mil in net income, 20 mil last quarter, 20 mil, 12 mil. So if we, like, this company just transitioned from a revenue list company to printing money. So they just got their FDA approval for deaf and cath. They finally, like, you could not buy the stock in 2022 because the revenue was 20K a quarter, but now they have real revenue. And look at these margins. So on this 39 mil of revenue, they netted 19 mil. So they have literally 40% net margins. But they did have a one-time adjustment. Like, it says they made 108 mil. They didn't actually, but they actually made 51 million. They had a one-time adjustment because they just acquired a company called Malenta. So they're diversifying away. So since they're making so much money and they have no net debt, they own Def and Cath right now, which is the main winner. Literally the same time last year, this did 800K of revenue. This quarter, it did 88 million. At this growth rate, what's it going to be the same time next year? This is the main winner. But they also acquired Malenta for nice diversification. But there is this bad headwind where they get this like government subsidy revenue that will like end in 2027. So like the future far out expectations aren't great, but still, like, here's the thing. This whole company, what were they worth again? $550 million. And their analysts are expecting 70 mil of after-tax net income next quarter. 55 mil of after-tax net income the quarter after. Out of all the $500 million market caps, I want to buy the one that's making net income like this. So I did buy a little more of them, but again, that it's still one you don't want to have as a meaningful size position. What app are you using? Yeah, hey Swan, all these apps I'm using, they're all brokerages where you buy stocks, and they're all in the link tree in my bio. I'm not sure what app you're talking about. I don't know if you're talking about Robinhood. I have Robinhood linked up there. My favorite app to get if you want to buy stocks, cost nothing, free. My favorite one is actually Moomoo, this one right here. My favorite app, if you're looking to buy stocks, it's my favorite app to buy stocks on and analyze them on. Cost nothing, no commissions. Very first link in the link tree in my bio if you want to use my affiliate link. But yeah. Let's see here. Zeta is a data-driven cloud platform, provides enterprise. Oh, hey, thanks for that, Logan. Take Two, I would stay away from or have less than 2%. Yeah, this is a future story play. So if we look at their right now fundamentals, they look awful. Well, they don't look awful, but like if we just go to their net income right here, like this is just not what you want to see. For the past like 3 years in a row, like all the way back to 2023, all they've done is just lost. Cumulative loss, like 8 billion of net income. There's not a single quarter of positive net income right here. So all they've done is just lost net income for the past 3 years in a row. Well, if you don't know, what does this Take-Two? What does this company do? This is GTA 6 or GTA stock. They own a bunch of games like Rockstar Games, which is Red Dead Redemption and GTA 5. And there's this big future growth catalyst called GTA 6 that's going to come out supposedly very late 2026. Of this year, where that as soon as they release that game, it'll instantly bring them in billions of revenue and then potentially like billions of more reoccurring revenue for the rest of the time after that. So it's kind of like, what do you think GTA 6 is going to do? Because their right now financials don't look great. But it's that future growth story that is why people are interested in Duolingo. I was reading the chat and I saw someone say, can we go over Duolingo? I meant to say Take-Two Interactive, which is GTA 5. Duolingo is actually super undervalued. Yeah, actually, we'll look at Duolingo in a minute here. I forgot to get to AMD and ASTS. Let me get to ASTS first, and then we'll get to AMD stock. Can you look at Leonardo? Hey, we'll try and get to that one too. Did Moomoo show all the financial data? Yeah, well, they show like most of it. It's not behind a paywall, but you have to have at least $100 deposited in your account for you. Like all this data that I'm showing you right now, you can all see. But if you just click right here, like we don't even look at this stuff because I don't really care. Like the analyst ratings, you can see you see how it says member next to it. The only things you can't see is if it says member. And how do you become a member? It costs nothing. Your just portfolio has to be worth over $100, and you just become a member. So yeah, you get anyway. AST Space Mobile. This is one of those popular space stocks. Let's see. Satellite. So they just issued $1 billion to deploy these satellites, which is kind of smart. I mean, the whole company's worth $29 billion. So they diluted all the shareholders by 1/30. They basically locked in the $30 billion valuation or it was probably more at like $100 a share. Then they diluted and fell. But anyway, this is just a future growth story. If we look at the revenue, they're finally having revenue. If we zoom out, this was a record quarter of revenue. They did 14 million. Still not a crazy amount, but it's great news that they finally have good revenue. So they did 14 million of revenue. On this 14 mil of revenue, they actually missed. I didn't realize that they missed expectations. The analysts expected 19 mil. They only did 14 mil. But look at next quarter's projections. They're expecting 41 million. That's an insane jump from the right now quarter. So it's going to be 41 mil the quarter after, and then 34 mil. So it's kind of just a future growth story. We want to see them beat on these numbers. We definitely don't want to see them miss. But I'm not a huge fan of this one because look at these net income losses. This is why they have to issue debt or issued shares. I mean, to get $1 billion of cash because they lose a couple $100 million a year. So it's not one that I'd really want to own, but it's a popular momentum space stock. It's a better swing trade in momentum day trade than like a long-term hold, I think. Yeah, this app's called Moomoo. Link in my bio, very first link there if you want to use my affiliate link. So let's do Eaton. Oh yeah, I forgot about Eaton, my bad. And I'm missing on so many stocks. I got to get to AMD next. Samsung. Oh, I forgot their ticker symbol. I always try and find Samsung stock, but I can never find it. Okay, so here's Eaton right here. This is another electrical infrastructure play. Let's see if there's any specific news here. No, you also get a nice dividend. So if we look at the yield, let's see, a 1.1% dividend. So even at all-time highs, or close to all-time highs, you're still getting over 1% of your money back just in a qualified dividend every year. But look at the difference of the valuation. They're kind of expensive at a 35 PE, but on a forward PE, they're only at a 30. So not too shabby. But yeah, they also have this, Electrical Americas business, but then they have this aerospace business, which is 15% of their total revenue. It's growing very nicely, growing double digits, just hit $1 billion for the first time last quarter. So great news there. And the analysts are expecting the revenue to go to 7.6 billion in 2 quarters. Here's the net income. Yeah, easily over $1 billion in net income, like after tax. Yeah, the before tax is 1.39, after tax is 1.13. Like they really do make over $1 billion net income a quarter. That's how they pay a dividend and do share buybacks. So let's see the share buyback. So net income's up 16, net income per share is up by 18. So they've bought back 2.5% of the shares, giving you 1.2% in dividend. Very shareholder friendly. Nice little picks and shovels play. Let's do AMD real quick. Looney says, Lisa Su is the CEO of AMD. She's the queen of CPU. Hey, yeah. I think they just rose their CPU prices. I think I was just reading some article about that. What is this right here? Oh yeah, check this out. This is very cool. The third line here says the third line, AMD reports record Q4 revenue of 10 billion and projects 60% annual data center growth over the next 3 to 5 years. So that's a CAGR. They're going to CAGR their data center growth at 60% a year, and that's their biggest business. That's what's so huge. If we go to their data center revenue, it's 50 or nearly 50% of all their revenue. Check out the growth on a quarterly basis. It's up 39%. After grew 69, after grew 37. So these year-over-year growth rates in the middle look phenomenal, and it's just going to continue to grow, for the next 3 to 5 years. Just this business at what was it, 60%? Look at the client revenue. That's also up crazy 50%. So anyway, it's very cool to see the growth is back on AMD. The revenue's up 35%. Net income's up 213 to 1.5 billion. That's the highest net income they made, like pretty much ever. So record net income, record revenue, no net debt, fortress balance sheet on AMD. It just seems like such a safe stock, and they're investing in the future as well. They still have good free cash flow. Like we see a lot of the CapEx, all that CapEx spend goes to companies like AMD. So they actually do retain and keep free cash flow of 2.4 billion, up 117%. We zoom out, that's like a record free cash flow. It's never been higher. So anyway, AMD, I really do like. They are still a slight bit expensive, but the price to earnings growth is like under a 1. Like if I was a shareholder, and I certainly would not be selling or trimming, but I wouldn't buy too much. Like I do a slight nibble. If I didn't own this one and wanted this as like 5% of my portfolio, I'd make it 1% today, but no more than 1% at current valuations. But it is good enough to go ahead and start buying a slight bit of, though, but not too meaningful yet. Okay, let's look at some more here. CoreWeave stock. Oh yeah, CoreWeave. That's a big. I have a cool story about CoreWeave. They're a big company that NVIDIA owns. So here's the NVIDIA portfolio. Their largest holding is Intel. Then they own CoreWeave. So basically CoreWeave gets a bunch of money from, issuing shares, and they get money from NVIDIA. They basically they take out debt and buy a bunch of NVIDIA chips. So they like more than they need. So they have this crazy surplus of NVIDIA chips, and they undercut all their competitors' pricing. So that's why this one's seen a lot of demand. And NVIDIA is a big shareholder here. Let's see if there's any news here. Blue Owl Capital fails to secure $4 billion debt financing for CoreWeave as the anchor tenant. Wow. Okay. Well, anyway, wait, what did that say? CoreWeave cuts their full year 2025 revenue guidance. So they actually cut, if you look in the middle there, they cut their full year 2025 guidance to 5.15 billion, faces debt maturity and insider selling scrutiny. But anyway, the main thing you watch is just the revenue growth, because the revenue growth has been insane, but it's not like profitable growth. And check out the expectations. The revenue, this was a record quarter, 1.36 billion. Next quarter, it's supposed to be 2.23 billion. Insane revenue, but the profits are bad. Like here's their net income projections. Like, look, they're supposed to lose 350 mil, 223 mil. So they're still supposed to lose, a couple hundred mil a quarter, which isn't great, but it's an interesting business model. Like in the long run, there's nothing really blowing me away here. It's just like a higher beta NVIDIA. I think it'll probably still do good through the end of the decade. But all this company does is they literally just own a bunch of NVIDIA chips in a data center. Nothing proprietary, nothing like exclusive, just owns a bunch of chips and undercuts their competitor pricing by taking out debt in that NVIDIA partnership. So interesting though. First time joining. Great. Thanks hey, Jabbar, I appreciate you, man. I hope you're having a great Sunday. I do appreciate you. What should we look at next? I love the GTA franchise. However, investing in Take-Two is risky. Yeah, I agree, Logan. The Take-Two stock, I'll definitely be a customer of Take-Two. But Take-Two stock isn't cheap enough. So let's see. Oh, hey, Larry, what's up, man? Larry says FLNC. Let's, what's this one? We're FLNC. Yeah, okay. And then we'll do InnoData. And what up, Steven? Market to dip with these new tariffs. If so, we buy and hold. Actually, a good way to, I guess, kind of predict what the market's going to open at is look at Bitcoin really quickly. Sometimes Bitcoin gives us a heads up. Okay, so I guess, here's Bitcoin. Looks like Bitcoin's down, I guess, 1%. So the market opens at 8 p.m. tonight. I might be live tonight at 8 p.m. I'll see. But yeah, here's my portfolio. We'll see. I actually don't own any crypto. I kind of own the crypto picks and shovels plays like Webull stock and Robinhood. So here's Fluence Energy. So unfortunately, they're the same prices they were kind of when they IPO'd. Let's see what they do. Revenue from energy storage products and solutions. So how's that growing? Their total revenue. So it's kind of choppy, but it's still a lot of money. Like if we average it out, it's like 600 million a quarter. Ooh, so here's their profits. So it's not really trending, I think, how investors want. That might be why the stock has kind of been disappointing. Like these are all year-over-year declines on the profits. So some of the revenue is up, like revenue's up 150%, but the profits are down and they lost 63 million more than last year. So, yeah, I don't know. I wish I could. Oh, look at Simmons. I don't know if that's like the company Simmons that owns them, but it's an interesting company here. So they're a utility renewable energy company. Maybe we can check out their website. Tier 1 energy storage supplier. So large battery projects. So yeah, just like stacked up batteries, I guess. I don't know. I don't know if it's like a commodity or something, but I want to see the profits kind of get better. Hopefully that was kind of helpful there. It probably wasn't too helpful. I apologize there. But PAGS Financials, what's that one? We'll check it out. And then we'll do Leonardo and then Fix. Yeah, Comfort Systems. I would go over that one, but they're at a crazy all-time high at a valuation that's too high. But actually, you'd love my most recent YouTube video. By the way, if you want to support me, check out my YouTube channel. It's called Nathan Robert. You can just type it into YouTube. I'm also streaming on there. Someone says slow down. Yeah, if you can like rewind it on the YouTube stream if you want. Sorry if I'm talking too fast, but yeah, that's the best way to support me. Watch a stream from YouTube. And my most recent YouTube video, I spent the whole first like 5 minutes just deep diving into Comfort Systems earnings. They were great. So here's PAG Digital. I don't know about this company. They're lower than they were in 2017. So the stock has not done too well. Let's see if we can figure out what they do. The forward PE is a 6.8. So that's a very cheap valuation. So they're actually headquartered in Brazil. All of their revenue, or 98% of the revenue, just comes from Brazil. So some sort of Brazil company. And they did miss on revenue this quarter. Analysts expected 984. They only did 959. So they did miss on that a little bit. But they still make net income every quarter. Yeah, if we zoom out here, and this is in US dollars, they're still making easily 100 mil a quarter. So even though they missed a little on expectations, they still make 100 million in net income a quarter. So that's why they trade it, a cheap 7 forward PE. But I don't know what the moat of this company is. Some sort of software digital payment company in Brazil. Individual entrepreneurs, micro merchants. So in-person payments via POS system. So anyway, that's a Brazilian software kind of financial player, something like that. Jabbar says Enphase Supermarket. Yeah, actually, which one should we go over there? Amcor, we were just looking at this one. This one's kind of interesting as another CapEx beneficiary. Hey, no way. Shout out to the legend Cruz on the YouTube stream for the super chat. Yo, if you got a stock, give me a look at. Let me know, Cruz. I got you. I always appreciate you being here. So, and hey, Koner Walk said, appreciate your streams. I'll keep coming back. Hey, thanks, man. I appreciate you. We'll be live for another hour. We stream every Sunday this exact same time. So if you happen to be free every Sunday this exact same time, we stream every Sunday this exact same time. We try to stream every day as well. All the streams are on YouTube as well if you missed anything. So here's Amcor Technology. They're close to an all-time high. So congrats if you own this one. They've certainly been on a nice little run up, and even close to an all-time high. This is why I think they're probably going to continue to climb higher. They're only at a 25 forward PE. So trading at 25 times next year's net income. So, it could probably stretch up to like a 28, 29 forward PE, send this up to an all-time high. So they do advanced products. I don't know what that is specifically, but here's their net income. It grew nice. It's up 172, up 63 million year over year. That's one of like the highest net income quarters they've had in a really long time. So they do make net income every quarter. Again, the net income's a little choppy since 2021, but it's the future guidance that's been great. Yeah, check this out. This quarter specifically versus what analysts expected. That's why they gapped up. The analyst, there we go. Sorry, expected 109 million of profits. They did 171. And last quarter as well, they expected 104. They did 126. That's a 30% beat. In the quarter before, they expected 38. They did 55. That's another like 40% beat. So they've beaten like crazy on net income for the past 3 quarters in a row, and revenue. They beat like 5 to 10% on revenue every quarter. So they're beating on expectations. Kind of a cheap valuation. And I think you get a dividend, 0.69% dividend, safe payout ratio. So it's an interesting infrastructure name there. All right. Yeah, let's do what was that one I wanted to look at? Oh yeah, SoFi for JL. Yeah, I'll be quick about SoFi because we already looked at them, but I got you. I said I'd come back to them because I love SoFi right here. I am a shareholder of SoFi, full disclosure. The metric you really want to watch on SoFi is this. It's their financial services right here. It's 44% of the revenue now, which is great. It's becoming a bigger portion of their business every day because it's so growthy. It's the growthiest business. This is what analysts are watching. This business grew 76% year over year. After grew 101, after grew 141, after grew 287. So it literally every quarter, every year just hits a new record. So that's why I think people are really starting to take SoFi serious because they're beating on expectations every quarter by a lot. And the expectations are great. Like net income is supposed to be 200 million in 2 quarters. They'll be making close to $1 billion of after-tax net income a year. And check out that revenue growth. It's just up and to the right. So if they're going to be making close to $1 billion of net income a year, pretty confidently, I can say, and the whole company's worth $24 billion, that means SoFi trades at a 20, well, my math, like a 25 forward P, but yeah, analysts are saying they're trading at 28 times next year's net income. That's why I think SoFi, the risk reward is very fair for a nice growthy name. So I think the risk reward looks very fair. I don't see them getting much cheaper. So I go ahead and start a small nibble on them at current prices. I know you love it, but can you please do Meta? Yeah, Marcus, good to see you, definitely. And then we'll do Sprouts Farmers Market and GLW. Yeah, they just got a huge. Actually, speaking of Meta and GLW, they just signed a huge deal with GLW. So let's see here. Meta launches 65 million political initiative to support AI-friendly state legislators. Oh, and Bill Ackman just bought a bunch of stocks. So anyway, this brokerage is telling me that there, I guess, is a bearish flag forming. Oh, well, that doesn't matter to me because Meta, we judge off their fundamentals, and the fundamentals are so great. And hey, thanks again, JL, for the rose or that gift there. I appreciate that. Meta's even cheaper than SoFi. Meta trades at 21 times next year's net income on a forward PE. And why do we look at the forward PE and not their trailing 12 months PE? That's because they had a total one-time adjustment last quarter to their net income / EPS. Like, look, you see last quarter, it says they only made, says they only made 2 billion. They didn't actually. They really made the normal 18 billion, but they had a normal, this one-time adjustment. So if we zoom out to the non-adjusted numbers, like the profits are at a record. So they're trading at 22 times forward PE, revenues at a record. There's a nice earnings tailwind as well. So much more runway for growth because they're introducing ads to Threads and WhatsApp. Threads nearly has the same amount of daily active users as X has. And one thing being questioned though on Meta is how much they're spending on AI. They're definitely spending more than they're making. They're spending and they just projected to spend 150 billion just in 2026. So they're going to be literally spending 40 billion a quarter for the next 4 quarters in a row, which is the highest they've ever spent. So, and we are questioning, will Meta get a good return on that? But I'm a fan of them spending this money. I wouldn't be opposed to them cutting it back a little bit, but I love the Meta Ray-Ban glasses. They're introducing a Meta smartwatch now. They're getting into hardware, and they print money with their ads. They literally have, if we remove that little adjustment there, they literally have a 40% net margin on these ads. They just print money. So I'm a big fan of Meta. With Instagram, here's their active users. They literally have 3.54 billion daily active users between all their apps. WhatsApp, Messenger, Facebook, Instagram. Average Facebook user makes $50 a year for them. Let's see if I can find Leonardo. Leonardo. We found it, I think. Okay. Leonardo ADR all-time high. Yo, congrats if you own this stock. You're definitely up on your money. I've never heard of this one actually. So their European name will convert the currency to US dollars just to get a better picture here. So yeah, defense, electronics, and security. That's pretty cool. You also make helicopters, aircraft, space, cybersecurity solutions, aerostructures. That's pretty cool. I like how diversified that they are. How are their helicopters revenue? Up 16% year over year. So pretty cool. And here's their net income, real US dollars after tax net income. They're easily making, if we average it out, like 300 million of net income. So that's phenomenal. Do they have a forward PE or, well, they trade at 32 times net income. Well, they're probably expensive because they're at an all-time high right now, but I can totally understand why they're at an all-time high. Their fundamentals did look good and you get a 1% dividend nearly. So that's actually a pretty cool name there. They make helicopters and stuff. When did Guy bought a lot share? Forgot his name. You just mentioned Meta stock. When did Guy bought a lot? I don't know what you mean there. I'm probably just slow. All right. Let's see. Cruz said, can we check out GLW? Them and Amphenol are going to have a micron. Yeah. So I love the fiber optics cable solution business because it's just like the nervous system of AI, they call it. And they just signed a huge deal with Meta. Oh, it's already gone from the news, but they signed like a $5 billion deal with Meta, which is just going to add even more to the future. One of their biggest customers are Apple. Like they make the Gorilla Glass for Apple. And they do the fiber optic network. So they are expensive at an all-time high. Like I wouldn't buy this one. Amphenol is actually pretty fair, like a 31 forward PE. But yeah, Corning's at a 48 forward PE. But yeah, here's their optical communications business display, which is, their Gorilla Glass. But check out this specifically. This is the incredible part if we zoom in here. The revenue is up 20% year over year. So the revenue is up by 20, but the profits are up by 71. So, that's margin expansion. That's what that is. When the revenue's up 20, but the profits are up by 70, like these growth rates are phenomenal. So yeah, the gross margins are up by 4 after they grew 12 and a half. So anyway, Corning's pretty impressive. And the future expectations are quite good. Yeah, revenue's going to go from 4 billion to 4.6 billion, but I wouldn't buy it at current prices. But I can see why they're at all-time highs. They're just a huge beneficiary of all this crazy CapEx spend. Yo, what up, JE New? Can you look at Corsair? Yeah, I remember Corsair. Didn't they just run up on the memory shortage stuff? Is that CRSR? Oh, it is. Dang, they sold that off quick. Look at that. So they gapped up from $4.50 to $7.68. I just remember they sell a bunch of gaming equipment like keyboards, mouses, and I think they said because of the memory shortage, they were able to like raise prices and they made money, I think, so they actually beat by net income by double. Analysts expected them to make 11 million and they did 25 million. So that was a good beat. They beat on revenue as well. So yeah, look at that gross margin expansion. Gross margins are up by 26% year over year. I think they're just able to raise prices because of the memory shortage. I don't know. So yeah, that sent them up to a nice 26 mil of profits. Do they have a forward PE? I'm assuming not. Or it would be, oh wow, a 31 forward PE. So anyway, this one it's like one of the smaller beneficiaries of the memory shortage. So, it's maybe something to look into. I don't know. COKE versus KO. So yeah, this is the company that Warren Buffett owns, Coca-Cola. They're the main, company that sells the syrups and stuff. Coca-Cola, this company sells the syrups to this company right here, Coca-Cola Consolidated. This is the bottler for Coca-Cola, Monster, Dr. Pepper. So that's the difference between them. Difference in market cap, Coca-Cola Consolidated is worth 12 billion when the main Coca-Cola company is worth like 250 billion. So I own the bottler, COKE, the consolidated one. What I mean is you said someone bought a lot of shares of Meta. I forgot his name. When did he buy it? Someone, I'm so sorry. I just do not remember. Oh, I think someone said in the chat, I think I was maybe reading someone's chat. He was just like, I just bought a bunch of share of Meta. Can you check it out? Oh, no, that was Bill. Oh, I know what you mean now. Oh, I remember what you meant. That was Bill Ackman, the super investor in Pershing Squared. So yeah, check this out. Bill Ackman, Pershing Squared takes a $1.7 billion stake into Meta. Pershing Square, dang, they exited Chipotle. Dude, that guy was pumping Chipotle stock. Increased its Amazon stake. So anyway, that I remember now. Sorry. Okay, can you recommend a couple of growth dividend stocks? Thanks. Well, actually, I don't know about their current valuations, but I love dividend growth stocks, and that's this whole portfolio right here. If you look in the top left, this is called my dividend only portfolio, where every stock in here pays a dividend. And these are all dividend growth stocks, as you can see. They don't have like a crazy high dividend yield like a Google, Meta, Constellation Energy, United Rentals. They'll have low yields, but in 5 to 10 years, my yields will be crazy. And actually, every stock in here pays a dividend as well, except for Amazon. So yeah, all these are my favorite dividend growth stocks. But I do have a bit of a higher yielding list. Like if you like higher yielding names that are still good and growthy, like an AbbVie I love, Procter Gamble, Taiwan Semi, Coca-Cola, Cisco's decent. Oh, McDonald's. I'm a big shareholder of McDonald's and Johnson & Johnson oncology play. JP Morgan's good. All right. Next up, we'll do so if I bought it 20 or $2.20 or dang. That's crazy, MH. You got a good crossway. Says, yo, shout out to Tangrika on the TikTok stream. No way, Tangrika. I really appreciate you with that crazy gift. That was so cool. I really appreciate you. Yo, I thank you to everyone on the TikTok stream. TikTok's already kicked me out of or removed me from For You page eligibility, so the viewers are cooked, but I appreciate everyone that's still here. So yeah, best way to watch the stream is actually from YouTube. Watch it on YouTube. What console do you play when you get GTA 6? I'll play it on my PC. I'm a PC gamer. I love Rust, CSGO. Hey, what's up? Hey, shout out to Legend Aaron. I hope you're having a great Sunday, man. Thoughts on TPL and there was one I saw before that. Snapchat stock. Yeah, hey. So I think they just got some profitability this quarter, but this one for the longest time has just not done well. But they have a lot of daily active users. They have 474 million daily active users. So they have quite a bit of daily active users. But here's the net income right here. The good news is they did make 45 mil in net income this quarter. They really did. But all the other quarters, like when we average it out for the full year, they still lose a couple hundred mil in net income a year. So that's not great. How's the revenue doing? So the revenue's up 10%. So basically they're trying to make all their users pay for their subscription to look at your previous ads or memories. I mean, so Snap Direct revenue business reaches 1 billion in annualized run rate with over 25 million subscribers. Snap launches creator subscription program, 500 million share buyback program. So I don't know. I'm still not buying this one. I like Reddit. Reddit's a significantly better and cheaper buy with better growth, I think. Reddit and Meta are better buys, I think. But that one's still I'm actually impressed with how they've gotten better. Someone said, what app is this, please? Yeah, hey, Mr. Lee, it's the very first link in the description. It's a brokerage called Moomoo. So it's an app where you buy stocks and, they ask for a bunch of information. But yeah, very first link in the link in my bio. Brokerage called Moomoo where you buy stocks. My favorite app. Can we look at AMPX? Let's do it. Oh, and I'm missing out on some stocks here. I'll try and get back to them. Sorry if I missed any. Oh, I can see QTUM, please. Yo, Jimbo, once we look at Quantum. I have nothing good to say about Quantum stock, Jimbo, but I will still check it out for you. Hey, what up, Mike? He says par. We'll look at par too. So here's Ampress Technologies. They're on my watch list. So there was something that impressed me here. Let's see what they do. So sales of battery products. Oh yeah, this is that company that's getting their first ever sort of sales. So if we zoom out here, the revenue this quarter was 21 million. So here's the cool part. That was a record revenue quarter. It's never been higher than it was before today. So they did 21 mil of revenue. On this 21 mil of revenue, actually what I meant to say was, Analysts expected 16.8 million, and then they did 21 million, and the growth isn't done there. Next quarter it's supposed to be 23 million, and then 23 million again. So if you kind of annualize that, it's kind of close to 100 million in revenue a year. So we're basically just watching if they can continue to beat on these expectations of sales every quarter, and that's what will keep the momentum going up. We definitely don't want to see them miss on these expectations, and they're actually not losing that much money. That's the other good thing. I see a lot of kind of startup battery stocks like this as well, and they lose a lot more money than this company. Like this company only lost $3 million. Like they've narrowed the losses significantly, and they have a good balance sheet as well. So you kind of just watch the revenue growth here, see if it beats expectations. But I wouldn't trust a meaningful amount of money in that one. I keep it as a small position. So PARR, PARR. Then we'll do quantum. And then what is UAA? We'll check that one out too. So Par Pacific, this might be an oil stock, or I don't know. Let's check it out. I don't know. So refining, so yeah, an oil and gas kind of commodity stock. So they're probably trading at like a low multiple. Yeah. So that's why they trade at 9.4 times net income, just because it's a commodity oil and gas stock. So if we go to the revenue, so all oil and gas stocks kind of look similar to this, with the revenue decline just because the price of oil right now. Like the sales, the revenue's down 6% after it fell 16. So not a decline of revenue for the past 5 quarters in a row. But look at the profits. The good news is, I guess, they did make this quarter a good amount of profits. They made 350 million. So something happened to their margins this quarter, where yeah, look at that gross margin expansion. It went from a 9% to a 25%. So I'm not sure what happened, but the margins just exploded higher. Yeah, that was a big beat. Analysts expected 98. They did 262. And they really was a beat. Huh. Did they like sell an asset? No. That was an interesting quarter. Good quarter there. So QTUM, this this is an ETF. You know, I didn't even know what this was. So this is actually an ETF. So this is the Defiance Quantum ETF. So it owns a bunch of quantum stocks. Let's go see what it owns. So this is an ETF. It means it owns a bunch of different individual stocks. Let's see what it owns. So I'm glad. So I'm looking at the list right now. A lot of popular quantum stocks are like RGTI and QBTS. I'm glad that those aren't even in the top 10. Like the real best aerospace and defense plays are like a Honeywell, a Google, a Microsoft. But here we see what's QNC? How's that stock? That one's at worth $1 billion. So Micron's in here, Teradyne, Lockheed Martin. So it's kind of like not a pure quantum ETF, but it owns some better names, like good names that I don't. But some of them I wouldn't own. I don't know. I don't know about that one. Oh yeah, we'll do InnoData. We have not done InnoData. Let me do TPO really quickly. This is a nice royalty play. So they own a bunch of like acres of land in Texas, and basically they let other people take all the like water and oil and gas and minerals from it, and they just collect a royalty. So if you look at a lot of oil and gas stocks right now, like we just looked at one, the revenue for all of them are on a massive decline year over year. Like look at this one, the revenues on this company that was actually up 17%, after grew 10%, after grew 10. So they're on a nice streak of growth, and it's not just the revenue, but the net income as well. The best part is actually their margins. They literally have, like no other oil and gas stock has this because they collect a lot of royalties, a 60% net margin. So their net margin's incredible. Like their total revenue is 203 mil. On this 203 mil of revenue, they kept after taxes 121 million. Plus no debt. Like that's a big cherry on top. Fortress balance sheet, no debt at all. They pay dividends too. So it's a cool little oil and gas play. But they're like different than a normal oil and gas stock, a bit more resilient. Oh, hey, thoughts on AppLovin? Yeah, we'll do AppLovin. That's one of my favorite stocks to buy right now. Let me do InnoData, then we'll do AppLovin and UAA, some of these other names. Did you see Blue Owl Capital and Ares sell-offs? They froze withdrawals. Yeah, the private capital market is really struggling right now. Yeah. So here's Innodata right here. This is one of my favorite software stocks to buy the dip on. But as a small position, I do own Innodata. They're one of my smallest positions. It's only worth $445, but they deserve a spot in my portfolio because I love them. Their main customers are literally Meta, Google, Nvidia, Amazon, and Microsoft. And they just got a huge new contract deal for the Golden Dome with the federal military or federal government, and a huge contract deal with Palantir. So I'm so excited about that. And we can see they've just been beating on expectations every quarter. Like this quarter, they expected 59, they did 62. And check out the future expectations. It's supposed to hit 69 mil and 72 mil. And I think like these haven't changed. I think they're going to dramatically beat on these based off that new Palantir and government deal. And they're not just beating on revenue, but they're already net income positive and making net income. They expected 4.7 mil. They did 8.4. So they're already printing net income. If we zoom out, you couldn't buy the stock by here. It was, well, I mean, they were barely losing any money, but now they're making good net income every quarter, growing their revenue very fast. So with good future expectations as well, no net debt, fortifying their balance sheet, making a good, here's the actual free cash flow. Yeah, that's what FCF stands for. Free cash flow is up 50% year over year. So I'm a big fan of this one, but I wouldn't go crazy into them yet. But I would honestly nibble. And I just bought a share literally on Friday. I bought a share at, where it is today at $45. So I am a fan of Innodata. Only risk is ahead. They only have a few customers. Yeah, it could be some customer concentration risk. Yeah. IDK, but the Leonardo should be 58 euros, but I think it's the same company. Yeah, that was probably because it's an ADR history harpoon. It's probably a different ticker symbol. But yeah, I know what you mean. What was that next? Oh yeah, AppLovin. This is an incredible growth stock at an incredibly cheap valuation. Like even after it's like gone up of 5% from its bottom, it's still a phenomenal buy. So right now, if we go to their forward PE versus current PE, like they look expensive right now at a 43 PE, but when we look at a forward PE, they only trade at 26 times next year's net income. That's so fair. And it's, I think, honestly cheap. Like this should be a 30 plus PE forward PE stock. So I think this is going to go up pretty easily, another 20, 30%. If we go to the revenue, like I'm not just recommending this stock because they're on a dip and on a cheap valuation. Like I'm recommending them because they're so quality. There's not many companies like this where the revenue was 1.66 billion. And on this 1.66 billion of revenue, they kept 1.1 billion of that after paying taxes, after they paid like 200 mil of taxes. So they really did keep 1.1 billion. If we zoom out here, this is what is so impressive. Every quarter, the net income just hits a new record. It's crazy, 1.1 billion. So that means their net margin is a literal 66%. So if you go spend $100 with this company on their ads, they keep $66. And check out every quarter under this, the growth rates of the margin. So this is a margin expansion play. Like the free cash flow too. The free cash flow's up 85% to 1.3 billion of free cash flow. So they can do share buybacks, M&A, invest in the future, all without having to dilute you. They could pay a dividend one day, and the net income isn't supposed to stop. The net income's supposed to go to 1.18 billion the next quarter, and then 1.25 billion the quarter after. So that's how, the analysts have this at a really cheap 26 forward PE, and that's assuming they just perfectly meet expectations. They've been beating on net income usually. So very attractive growth name. I definitely put on the watch list. One I'd happily own. Yeah, I just really like that one. What was this one? Curious. Oh, UAA. Yeah, let's get to UAA. Oh, Under Armour. I didn't know that was Under Armour. Actually, they've been doing decent the past 2 weeks here, but it's when we zoom out on the monthly chart that it starts to look a little yikes. Technically, Under Armour is the same price as they were back in 2007. So you bought the stock in 2007. It's the same price that it is today, unfortunately. I'm just not a big fan of the commodity of shoes. They're kind of losing their luxury feel. Like Nike still has a little bit of that, but I don't know if people like rocking Under Armours. But look at this. If we go to their number of stores, they actually have 450 stores right now. So yeah, they just sell apparel and footwear, very competitive, low margin industry. And how's the revenue doing? The sales, the lifeblood of the company. I can start to understand why the stock is the same price that it was in 2008, because if we look at the revenue, it's trending down and the growth is negative. The sales are down 5.2% after it fell 5.7, after it fell 6%. For the past 3 years in a row, it's only negative year-over-year declines to the revenue. And if we go to the profits as well, or net income right here, like it's just tough. Like they used to make some profits back here, but now, like for the past 4 or 5 quarters in a row, not a single dollar of, net income. So it's just nothing super blowing me away there. I don't really expect that to really outperform the tech-heavy S&P, but it could be an interesting trade still. It's not like it's just a them problem. Nike as well. Nike stock is very much off its peak. I actually used to own Nike. I did completely sell out of Nike at $79. Um, but yeah, the whole industry is struggling there for apparel. All right, let's see what's next here. The Blue Owl stuff. Oh, and Energy Transfer. Yeah, we'll do Energy Transfer as well. The Blue Owl, that stickers, is that OWL? So yeah, there's like two different ticker symbols. There's OBDC and then there's OWL. I think it's OWL is the main one, or I think they changed their ticker symbol. But yeah, this is a BDC right here, a business development company. Basically, uh, they give out money to private companies in exchange for, they do first lien loans, second lien loans, and they get like preferred equity. And because of the way they're taxed, they actually have to pay out 90% of their taxable income in the form of a dividend. So if we go to their dividend right here, they actually have a 7.5% dividend. That's just because of how they work. They have to pay that out. Yeah, some of the there was news around like they can't get the investors to back them. The private credit is just in a tough spot right now. Oh yeah, they were trying to raise $6 billion for CoreWeave data centers, where the tenant is CoreWeave, and they couldn't do it. I don't know. They've just been in the news. That's a BDC right there. Actually, if you're looking to get exposure to BIZDs for that, or BDCs for the income, check out ticker symbol BIZD. Actually, it looks better on Webull because most of your returns do come in the form of a dividend. So I do want to look at the dividend reinvested chart over here. Yeah, so here's BIZD. So here's obviously the COVID crash, but this ETF right here has in the very middle there a 12.7% dividend yield. So you get 12% of your money back just in a dividend every year, but you won't really get any stock price appreciation. So what was this one next? Oh yeah, Energy Transfer. This is actually, interestingly, this is an MLP. We just looked at BDCs, which have to pay out 90% of their taxable income in the form of a dividend. So does this company. So this is an MLP, which stands for Master Limited Partnership. And because they're an MLP, this is the thing I don't like, they actually give you a K1 tax form because you're technically a partner in the company. You're not a shareholder. You're actually a partner in the company. And because of that, they give you a complicated K1 tax form. So, but that's also why you get a 7% dividend. That's crazy. You get 7% of your money back just in a dividend every year, but that's because they're taxed differently. The dividends, when you receive them, aren't taxed as a qualified dividend. They're taxed at your ordinary tax rate. But yeah, this is an it's an MLP, but they're an oil and gas like transmission line company. So yeah, oil, crude, transportation services. Oh yeah, they have a big investment in Sunco. That's a cool stock. So yeah, they have a bunch of pipelines that they move oil and gas through. And we can see the revenue it's down 4% year over year, but it's still $20 billion revenue, and they keep $1.3 billion on that. So yeah, it's an MLP. And they're the largest shareholder of ticker symbol Sun right here, which is Sunoco, which has done phenomenal, actually way better than ET. They're at an all-time high, and this doesn't even include the reinvested dividend. On that chart, this even looks way better. But yeah, if we go to shareholder here, the largest shareholder, 20% of it is Energy Transfer. So do you use technical indicators when buying a stock for a good entry price? Not really. I mean, like sometimes I'll look at RSI for the fun of it, but it's almost never a main factor in when I buy a stock. Like I'm buying it for its fundamentals. Like, yeah, I don't look at any real technicals. Like, I don't know. Yeah. I do like Fibonacci retracements, but even that I don't really use that much. Because what moves the stock in the long run is the financials. So here is a UZG. My bad. Yeah, let's do Sprouts Farmers Market, and then we'll do Walmart. Walmart is a big competitor to Sprouts Farmers Market. So yeah, I think the reason the stock Sprouts Farmers Market is selling off so much is because they're being out innovated by their competitors. Like pretty much anything you can get at Sprouts Farmers Market, you can most likely get at Walmart and Amazon. And those two businesses will deliver it to you. They have an online delivery business where on Sprouts Farmers Market, they don't really have that online presence. So it's like a physical store, potentially replace. I don't know. But that's why they're at this two. They're so cheap. If you look on the right, they're trading at 12 times forward PE. That means they're trading at 12 times next year's net income. And, grocery stores are really a net margin play, low margin industry. And what I love about this one is they're expanding their margins very nicely at the very bottom, or not very bottom, but like under the percentage, you can see the growth rates. Like every quarter for the past 5 quarters, it's just margins up and up and up. They have double the margin of a Kroger, double the margin of a Costco, or more than a double actually, or close to a triple some quarters, like an 8% net margin. And what's cool is they don't pay a dividend. So like Kroger, Costco, Walmart, a lot of their net income gets paid out to a dividend, but this company pays no dividends. So then what is Sprouts Farmers Market doing with all this money right here? Well, the best part is the share buybacks. They buy back. Let me actually pull up the number. Like so much, 40, dang, they bought back 200 mil of their stock that quarter. They do massive share buybacks, and they've done that for all of eternity. So it's good to know, like, they're not diluting you. They're actively buying back their own shares every quarter. So I'm a shareholder here, and I'm down bad on them. I like being transparent. Check this out. I'm down 47% on my Sprouts Farmers Market. But am I selling? Absolutely not. I'm actually slowly like buying more. But I am being cautious because, again, the better buy here might just be like an Amazon, because Amazon could, I don't know, they have the online presence and undercut Sprouts Farmers Market. I don't know. But anyway, I just love the financials there. And I like the grocery store. And I like them because they're like a healthier grocery store. It's always like a nice vibe going into a Sprouts Farmers Market because they're like a healthy oriented grocery store. So that's why their margins are higher than like a Kroger. Hey, you too, Larry. Hope you have a great day. Outwork said just joined APLD. Yeah, I'll do APLD. Let's do that one. And then we'll do some of these other ones. Should I buy more of Leonardo and Kongsberg Group? Hey, that's up to you. Those are both international stocks. Do you like U.S. aerospace and defense names? Like Raytheon's a real nice one. But a lot of these aerospace and defense stocks, it's tough to buy them at current prices because they're all at all-time highs because it's like a nice hedge right now. If the geopolitical war fears start to escalate, those are nice hedges. And then we'll do Walmart after this too. So here's APLD. Actually, I think NVIDIA is a shareholder. Let me actually see if that's true. If you go to the NVIDIA portfolio right here, no, I'm not seeing it. Okay, maybe it's just so tiny of a position. But anyway, APLD, this is one of the data center stocks. So they do the same thing CoreWeave does. They do the same thing as Nebius. So that's why I don't love this one in the long run because there's nothing proprietary. They literally just own a bunch of chips and a data center. But what's cool is the earnings beat. It was a massive beat on expectations. Are you using the Moomoo app? Yeah, I'm using the Moomoo app. Hey, if you want to get it with my affiliate link, very first link in the link tree in my bio. But yeah, check this out. The revenue expectations this quarter was 81 million, but they did 126 million. Same with last quarter. It was an insane beat. They expected 45. They did 65. So just these insane beats on earnings. But they're still not profitable. Like you can see down here, their net income, they're still losing not that much money, but they're losing like 20 to 50 mil a quarter. But it's good to see how crazy they beat on revenue expectations there. We just want to see what the long-term net margin play is because they're still expected to lose money, but we just watch that top line growth. Because if the top line keeps beating as they have been, I mean, the stock will probably just continue to climb higher. All right. I remember talked about APLD at $5. And it shot up to 30s. I'd invested 1K at the time. Hey, nice, Vega. You probably made some good money or something. Are you looking forward to reach your first 100K? Yeah, the vigilante. Yes, sir. All the stores in Sprouts Farmers Market is selling off. That will hit the bottom of a chart, then bounce. Kroger will bounce off $59. Yeah, Kroger, I think Warren Buffett has been buying a little bit of Kroger. These have been like defensive names with like, they always trade at low PEs, 13 forward PE, kind of a high yield there on Kroger. So yeah, let's do Walmart real quick. So Walmart right here, they have Walmart actually has a hedge over Amazon right now because Walmart, like if you want to get groceries delivered to you, Walmart can do it significantly cheaper than Amazon. It would cost Amazon. Let's see. Walmart CEO reports automation in AI investments delivering results. AI assistant Sparky users show 35% higher order values. Wow. So they're getting 35% more value in the order. uh, I guess when the customer sees us or something. Let's see, customer or Walmart customer penetration reaches a record 72% of the US households as budget conscious consumers shift to mass retailers. Wow. And Amazon just takes over Walmart as world's largest company by total revenue with 717 billion versus Walmart's revenue is 713 billion. Crazy. So pretty cool here. CFO says company working to mitigate grocery inflation and tariff related cost pressure. So if we go to their bottom line, Walmart prints money. Yeah, here's their net income. They're easily making, if we average it out, like 5 billion of net income a quarter. So that's how they can afford a dividend. Yeah, if we go to Walmart's dividend yield, you get a 0.8% dividend yield. So yeah, they're printing 5 bill in net income a quarter. Their margins kind of fall. Again, it's a low margin business. You know, we looked at Sprouts Farmers Market, they have like a 5 to 8% net margin. They're at like a 3% net margin. This had a one-time adjustment. They didn't actually have a 4% margin that quarter, but yeah, it's just a safe company. They have one of the best real estate portfolios in the world, like one of the most valuable real estate portfolios, kind of like a McDonald's, and the stock's just been up and to the right. I love what they're doing with Sam's Club. They're like copying Costco's successful business model with Sam's Club. They also got like the $1.50 hot dog. It's always a vibe in a Sam's Club. So yeah. VRT said Jimbo. Yeah, this is a Vertiv. Yeah, this is an AI infrastructure play. I think they do like water cooling, stuff like that. Um, but yeah, huge beneficiary of the crazy capex of the Mag 7. If we look at the forward PE, they are a little expensive at all-time highs, you know, at a 43 forward PE, but I can see why they're at an all-time high because they have really been beating on expectations. So if we go to the revenue right here, the revenue's up 22%. After grew 25, after grew 23. So yeah, the revenue's at a record. What about the profits? So yeah, so it's not like the stock is at an all-time high because of momentum. Like, no, it's like the revenue's at a record, the profits are at a record, never been higher. You know, what was the net income? 445 mil of after-tax net income. And analysts are expecting next quarter 325 mil, but then it's going to go to 493. So good expectations. A little expensive though. I remember they fell off or they sold off way back here because Nvidia was like, our new Rubin chip will not need water cooling, and the water cooling stocks fell off. But anyway, they'll do great. But I would not be buying the stock at all time highs right now. Heard the Amazon online sales were really good. Yeah, you know, with Amazon Prime Day, they always got good deals. Mark says BMNR. Good morning. What do you think of the ticker COKE? Thanks for sharing. Oh, hey, David, the ticker COKE. Are you talking about Coca-Cola Consolidated? Because I do own that company in my portfolio right here. This is the Coca-Cola bottler. So yeah, they bottle for Coca-Cola, Monster, and Dr. Pepper. So what's really cool, this is a unique stock where the CEO owns 70% of all the voting rights. So he controls what the company does. It's like a Christian values company. There's like like a chaplain in all their bottling facilities. They return 1.5% of their before tax money to the community. They always invest in their employees. So I've met the CEO. He's a great guy. I trust him. So I'm a shareholder here, and it's just been the margin expansion here. Like, the stock has gone up because the revenue's gone up. And also another big reason the stock just went up is because they bought back 22% of all the shares at $127 a share. So at $127 a share, they bought back 22% of all the shares that exist, which means that gives you 22% more ownership in the company, makes the dividend cost 22% less, makes the EPS go up by 22%. So they're just like an interesting defensive name. If you look at the normal Coca-Cola company, they're at an all-time high. A lot of the food names are close to all-time highs, like Pepsi as well. So they're just following that successful momentum. So they bottle beverages. That's all they do. And if we just look at the beverage industry, like Coca-Cola is at an all-time high and Monster is at a crazy all-time high. So they're just the bottler. Kind of cool. And they've had good pricing power because they invest so much in the community and all that. They keep announcing every quarter these strategic price increases, and their customers are just willing to pay. They actually bought, interesting. So I go all the way back. I remember I was listening to his whole presentation. He bought, he was bragging. He has one of the best performing stocks in all of history at like a 50% CAGR since like 10 years ago of his stock. But they bought his original, like granddad bought the affiliate rights from Coca-Cola for $1. The lifetime affiliate rights from Coca-Cola for $1. So yeah, that's how, anyway. Okay, let's see here. Oh, hey, yo, shout out the legend Aaron on the YouTube stream. Yo, we said Marvel with the $1.99 super chat. Dude, thank you so much, man. I greatly appreciate that. We'll definitely dig into that one. And hey, Isaiah, he says, thoughts on Amazon? I bought around 204. Yo, fantastic basis there. We'll look at Amazon after this. Yeah, I just bought a bunch more Amazon as well. Amazon's one of the best stocks out there to buy. So NU looks like it has more upside. Yeah, we'll do NU too. So let me do Marvel. Again, shout out to the legend for the super chat, Aaron. So here's Marvel Technology. They make chips. They're a semiconductor play. They sell chips, and they should be. I'm actually surprised the stock hasn't gone up more. They should be a big beneficiary of all these companies projecting more capex. Some of that should trickle down to Marvel Technologies and their semiconductor solutions. So yeah, they design, develop, and sale of integrated circuits, and they had a great beat. Or they there's two pieces of news to know here. They just sold off one of their businesses. So if you go to the cash from investing activities, again, if this number is positive, that means they're actively selling out of their assets. They actually sold off one of their businesses for $2.4 billion. So they received $2.4 billion. So that's why we're not going to look at their net income. Like if we go to their net income, it says they made 1.9 billion. Well, that's not what the core business is. That's from the adjustment from the sale. But if we go to the core business right here, it looks great. Like they're really making a couple. Oh my goodness. Hold on. They thinking I'm AFK or something. Okay. Sorry if that cut out for a second. They made me fill out the AFK thing. But look at this. If we zoom out, like the past 4 quarters, they're easily making like 300 mil a quarter when they used to lose like 300 mil a quarter. So they really have recovered their profits where they're really profitable now every quarter. And I'm really curious to see what the net income is going to be. Let's actually go check. So yeah, it's supposed to it's going to go from 177 million to 290 million. That, even after they sold off that business. So that's really impressive. The revenue is going to go from 1.9 to 2.27. So I'm actually I'm a real big fan of this one. But if we look at the forward PE, it's a 51, which might be a little expensive on a forward PE. But they deserve a high multiple because these net income projections are phenomenal. Like they're literally going to be making 300 to 400 mil in net income a quarter from now on. So yeah, $67 billion market cap company and a small dividend, a 0.3% dividend yield. Nice. Oh yeah, NU stock real quick. This is a cool Brazilian, like a Brazil cryptocurrency bank, or it's a crypto bank out of Brazil. That's what I'm trying to say here. And they're much more resilient than Bitcoin. Like if we look at Bitcoin, it's like 40, 50% off its all-time highs, but no, they're only like 5 to 10% off all-time highs. And that's because the fundamentals are so great here. Down there in Brazil, that's where, I'll show you that. That's where the revenue comes from. Yeah, 92% of the revenue comes from Brazil, then Mexico. That's where cryptocurrency for transactional purposes are actually really popular because here in the US, we actually have a good currency. We don't use it for much for that, but down there they actually do. But check this out. This is what's so impressive. Let me go to quarterly here. I can't believe it. And this is in US dollars. The revenue just hits a new record every quarter, every year, and not just the revenue. This is the unbelievable part, but the net income as well. And this is real after-tax net income. They made 780 million. These are incredible year-over-year growth rates. Let's see. Yeah, revenue is up 41, net income's up 41 as well to 780 million net income. So that means their net margins an 18%. It's just so good on NU. NU is PAGS's competition. Look at this net income projection. It's going to go from 550 to 930 mil. So they're going to be making nearly $1 billion of net income a quarter. So that's why even at their all-time high level, they're only at a 21 forward PE. That's why I think they're much more resilient than actual Bitcoin. And it's like a way to get exposure to Bitcoin in maybe a safer way. So Isaiah, thanks again. He says Amazon. Let's do Amazon stock. So how good is Dave at 175? We'll do Dave too if we have time. Need a GSL dip. Yo, that's actually the first stock we went over, I think, Michael. Or we did a I love GSL stock. But yeah, they're at an all-time high because of Zim, because Zim just got acquired. Oh, 15% tariff. Yeah, I want to see how that'll move the market. But yeah, Amazon right here. This is an ETF and one, grocery store play. It's like a UPS, Instacart, Walmart, Oracle, all in one. AI play, subscription play, advertising play, cloud play. Yeah, look at their cloud business, which is AWS, number one cloud service provider in the world by market share, like a 25% market share. This is growing like a beast. It's up 24%, after grew 19, after grew 14, after grew 21, after grew 38, just on an incredible streak of growth. And that on an annual basis does over 130 billion of annual revenue. And that's their high margin segment. Because, they're not making too much net margin shipping you a package overnight, same day delivery. But if we go to the revenue, like this is why Amazon's a phenomenal deal, in my opinion. The revenue just hits a new record every year, every quarter, and not just the revenue, but the profits. This quarter specifically was a record profitable quarter. They've never made more profits in one quarter before today. So that's why I took advantage of the dip. The only reason they dipped is because of the future sentiment around how much they're spending on AI. So Amazon, I can't believe it. The behemoth Amazon's only at a 26 forward PE. It's still cheap. So anyway, yeah, but what's being questioned is how much they're spending. They're literally spending like 40. They're going to be spending 50 billion of 50 billion a quarter for the next 4 quarters in a row. But that's what I like about Amazon, though. I like that they don't pay a dividend. I like that they don't do share buybacks. They just invest it all in the future to get that crazy revenue growth, crazy margin expansion in the future. You can't out innovate. You can't outspend Amazon. So they just win. Whatever they do, they just win. Like the day they announced they're doing what Instacart does, they're expanding their same day delivery business of groceries in 1,000 new cities. Instacart fell 20% that day. Let's go. I use a chart to buy anything and hope to enter at a lower price than what I could get. Hey, you could like sell puts. Or is that it's all right. Let's do. Oh yeah, Swan said Uber. Oh wait, Dave, real quick. Let me go over Dave because they're super cheap. Yo, this is one of my favorite. So they're on even at $176. Dave is cheap. Not financial advice. I wouldn't go crazy though. Like if I wanted Dave as 5% of my portfolio, I would not make it 5% of my portfolio at today's price, but I'd go ahead and make it 1%. I start a super small nibble only because I really like their fundamentals. If I go to the valuation here, this is what's crazy on the right. They're at a 14 forward PE. So they trade at 14 times next year's net income. Like that's like an oil forward multiple, but this stock grows like a behemoth. Like they deserve way higher. They deserve a 20 forward PE plus at the sort of growth that I'm seeing. Like the revenue is a crazy record. They did 150 million of revenue, and it's not just the revenue, the sales that are at a record, but it's also the profits, the net income. Check this out. There used to be a hard buy back here, losing 40, 50 mil a quarter, but now they're making 40 to 50 mil a quarter. And at this crazy growth rate, what's it going to be the same time next year? They're fortifying their balance sheet. You can see the liability ratio. The liabilities used to be 42% of the total assets. Now it's only 33 while growing the assets. Oh, the best part's the actual free cash flow. It's so good. It's 81 mil of free cash flow. They have like a 14% free cash flow yield. So like they make 14% of the entire market cap just in free cash flow a year is what that means. They have like an 8% earnings yield. They're just really cheap. And that's why I think the risk to reward still is pretty good. I am up already a crazy amount on them. I'm up are still 130% on them, but I'm not selling or trimming. I'm actually looking to buy some more, a slight bit more of them. So let me do Uber stock. So yeah, Uber, this is one of my favorite ones to buy on the dip too, because they're also cheap. Let's see if there's any news around Uber right now. Uber invests over 100 million in autonomous vehicle charging infrastructure. Yeah, and Uber faces intensifying robo-taxi competition because of Waymo and Tesla, Cybercab, all that. So, but I really think the winner is going to be Uber as the actual platform where all the users are, where you go to book your robo-taxi in. So if we go right here, this is a really incredible metric. Like there's all these fears, but all their metrics are at a record. This is their monthly active consumers. So not just monthly active users, but their monthly active consumers are at 202 million, when this exact same time last year, it was 171 million. So incredible growth to their monthly active consumers and on all their businesses. So if we go to their mobility revenue, ride sharing, that's up 18%. After grew 25, after grew 34, after grew 73. So they're just on a streak of growth there, and not just the mobility side, but also the Uber Eats side, the delivery revenue. It's incredible. It's up 30%, after grew 21, after grew 6. So literally the growth rate is growing on Uber Eats right there. And same with all their metrics. If you go to we also don't look at their valuation because they had a one-time adjustment. So these are the non-one-time adjustment numbers I'm going to show you here. Check this out. Because if we go to the net income, it looks choppy. Like it says they made $6.6 billion last quarter. They didn't actually. They made nowhere near that. So if we go to the before tax number, before those adjustments, this quarter specifically was a record profitable quarter. They've never made more profits than they did before today. This was a record profitability quarter. They made $1.7 billion, and not just profits, but free cash flow as well. They did $2.8 billion in free cash flow. If we zoom out, it's also a record. So that's why I really like Uber, because they're just falling, because the whole market's falling. Because the thesis might get hurt from robo-taxis and the software sell-off. But Uber is one of the best ones I like to potentially buy right now, because the valuation is starting to get very fair. Like I really don't see Uber getting much cheaper than this. On the right, Uber's at a 22 forward PE. Like I don't see it getting cheaper. Like I could not see Uber at like a 19 forward PE. So that's hopefully helpful there. I do like them. So let's see. HPSL said HPE stock. I'll get to that one too. And then we'll look at a few more, then I'll get out of here. I got to go. Dang, we've been live for 2 hours. I appreciate y'all. If you want to hit the follow button, we stream every Sunday, this exact same time, and every day I try to. So here is Hewlett Packard Enterprise, HPE. So is that like that laptop company, HP? I don't know. So they do servers, networking, hybrid cloud, and financial services. So nicely diversified there. How's their server revenue doing? So that is, it says it's down 5% year over year, but that's after it grew 50%. So maybe it's a tough comp. What did they do? So they did miss on revenue. They expected 9.91. They did 9.6. They missed on revenue, EPS. So they just had a slight miss this quarter. That might be why the stock, gapped down. But what's the valuation? They don't have a forward PE? Wait. Oh, they do. Okay. They don't have a current PE. Look at that. The current PE is a negative 534. But when we look at a forward PE, next year's numbers, they're at a 26 forward PE. So I'm guessing they had a big one-time adjustment. So I'm guessing this quarter, when it says they lost $1 billion, they didn't actually lose $1 billion. Yeah. So they didn't actually lose $1 billion. But the profits, that's not good though. The margins have just gotten wrecked. The revenue grew 14, but the profits are down by 48. So they're still making good money, like $300 to $400 million a quarter, but the profits fell. Look at that. This is the profits / EPS is just not really growing over time. It's lower than it was in 2016. So they're not even making more money than they did in 2014 even. They made more money in 2014 than they're making now. So that might explain why, if we zoom out on the stock, they're actually the same price as they were back in 2016, a decade ago. I don't know. I just don't think that one's going to outperform the tech-heavy S&P 500. But HIMS, please. Yeah, unfortunately, this one has been really rough. They're just intensifying competition. So basically, they used to sell Ozempic on their website in Wegovy pills, or I just mean Wegovy. But then Novo Nordisk out of nowhere ended the partnership. So that's where Novo Nordisk was selling their products on Hims and Hers. But now they abruptly ended the partnership with Hims and switched over to Amazon. So Amazon is almost like a mini Hims and Hers in ones, Amazon Healthcare. So they sell Ozempic products, and that was their highest margin growthy thing. That's what led to all their growth back here and all their profitable growth, because they can make crazy margins on this. They didn't make crazy margins on anything else. They sold these GLP-1 weight loss prescriptions for a bunch of money, and now they don't sell it anymore. And recently, back here, see, there's no earnings reports, but the stock tanked on crazy volume, on no news, or on no earnings. the news was they were selling a knockoff weight loss prescription, but then yeah, look at this. So they're facing potential DOJ action over a compound Wegovy product. The FDA is not happy with them right now selling this knockoff, infringing on patents and stuff. But they just acquired a business, I believe. So that they're trying to like M&A their way out of this. Like Hims and Hers just bought, I think it was called like Eucalyptus Therapeutics or something. They just like bought a company for like $1 billion. Oh yeah, look at this. Hims and Hers to acquire Australian digital health firm Eucalyptus for 1.15 billion. That's a lot of money, 1 billion. That's a game-changing acquisition because the whole company's worth 3.5 billion. If they're buying a company for 1.1 billion, that's literally like 30% of what the whole company is. So that's an interesting acquisition. But yeah, so basically we're in a scenario where the revenue's growing, like the revenue's up 49%. But the profits are down like crazy because they don't have the same margin. So the profits are down by 47, net income's down by 79. Like they only made 15 million of profits despite having the highest ever revenue quarter, way more than a year ago. But so it's a margin issue. Yeah, if we go to gross margins are down 7 after they fell 5, net margins down. So anyway, it's an interesting story, and it's not like they're cheap or well, actually a 32 forward PE, but that is if they're right, because they have been missing on net income expectations. Let's see that actually. So yeah, the net income is supposed to be only 9 million next quarter when they used to be making, 40 mil on net income. Now it's only going to be 9 million. So anyway, it's just a margin issue and a future sentiment issue and a patent issue. So I can understand why the stock is struggling. So 6-star, it says FERMI. What's this one? Oh, FRMI stock. So we'll do this one. Let's see. Hey, thanks, Outwork. I appreciate you, man. Hope you have a great Sunday. So this is a $5.6 billion company. They just IPO'd literally in October. So they haven't been public for that long. So we probably won't get too much data here. Yeah, we don't get, okay. So we don't have any data. We go on their revenue right here. It says no data. Maybe they're a startup. Maybe they've never sold anything. I don't know what this company is. I wish I could give you thoughts on them. I give you some deep dive analysis, but it says they're a specialty REIT. They're a REIT? No. So this is a real estate investment trust. Look at the employees in the middle there. It says they have one employee. I don't know what this thing is. World's largest next-gen hypergrid. Yeah, no, they're trying to get my cookies. There we go. World's largest next-gen hypergrid. I don't know what this company does. Maybe I can read down here. Mission to directly provide 11 gigawatts of low carbon power. Okay. So I wish I give you, there's just no revenue for me to look at. So anyway, interesting. I wonder why I put them on my watch list. Maybe there was some sort of good news, but I don't know. I like to enter cart at $32. What are the earnings? Let's actually check out cart earnings. Instacart, then we'll look at SoundHound AI. So this is Instacart right here. Amazon kind of does what they do now. Let's go look at their fundamentals. So they're actually very cheap on the right at a 15 forward PE, but that's just because, it might just be a commodity where Uber does the same thing and Amazon will deliver your groceries to you the same way Instacart does and maybe cheaper. I don't know. So yeah, they're at a 14 forward PE. That's so cheap. Analyst expectations are good. Revenue is going to hit over $1 billion next quarter for the first time ever, and it's going to stay over $1 billion. And they have a 15% net margin. That's pretty good. So look at that. They're going to do $1 billion of revenue a quarter, and on the $1 billion of revenue, they're going to make, so it looks like they had a one-time adjustment this quarter. Ooh, maybe they didn't. They're going to be making, I thought, like 150 mil of net income a quarter. Let's see, net income. So yeah, so this quarter looks like a miss. I don't know if that was a one-time adjustment. No, the real EBIT, earnings before interest taxes, missed by a 50%. So yeah, that might be real. They really did have a big miss on net income. Maybe that's explained away by something. But yeah, it's supposed to be 150 mil in net income the quarter after, and then 150 mil after that. So yeah, they should have around a 15% net margin at a 15 forward PE. Interesting. Yeah, so they're not expensive. What stocks are you buying this week? That's a good question because I have a lot of cash on hand. I have I'm probably going to buy like $500 to $600 of stock this week, but I don't know what I'm going to buy yet. That's a good question. It depends on what falls. I might not spend it. That I always like to be patient. There's a scenario where I probably won't even spend any of that money. I like being very patient, especially in this environment. So here's Soundhound AI. I don't love this one. I've been on their website before. Basically, you just input a bunch of your voice's data, and they'll replicate your voice based off whatever text you give it. So it just replicates your voice. I think it's going to be so commoditized. Apple already does that for free on the settings, and like basically, it's a subscription model company, and I think in the long run, it's not great of a business model. So if we go to their subscription revenue right here, this is the most impressive part. This is what you want to watch if you're a shareholder here. It went literally out of nowhere. It went from 300K of revenue a quarter to literally 33 million of revenue this quarter. And it's all subscription, reoccurring revenue, and it grew 78%. After it grew 3,700%. So they're just on a streak of growth, an insane streak of growth. Then that's the metric you really want to watch, because that's what they've been beating on expectations from. But it's still not great because they're losing a lot of money. Like, I don't know how, maybe just from storing all the data, cloud data, but they're losing 40 to 50 mil a quarter, and the losses are worsening. These are all year-over-year declines on the bottom. It's all negative. So the losses are getting worse. The revenue's going up, but I don't know. NVIDIA used to own the company. They fully sold out of them. It all depends on the subscription revenue. It's what you think about this in the future sentiment. I just don't love the voice, recreating your voice industry, I guess. I don't know. But that subscription revenue growth is super impressive. Can you make a video on what you're going to buy this week for us? Hey, I might do that. Yeah. What I bought last week is I've been loading the boat on Amazon. I'll kind of show you what I have been buying, because I just spent like $1,400, last week buying Amazon. But some of my best buys, I might even buy Microsoft for the first time. I'm probably going to buy maybe another share of Meta. But yeah, I bought $1,400 of Amazon back there. Bought another share of InnoData in my oh, hey, we already pulled up to it. In my Roth IRA, I now have 10 shares of InnoData. I bought like 1 share of Webull, 1 share of CorMedix. So I'm just slowly allocating money to where I think is cheap. Some of the cheapest names out there that are the best buys is Microsoft, Meta, Amazon, AppLovin. It's really good. Uber's quite good. Reddit, I really like. Let me actually pull up Reddit, because I saw someone say that. This is one of my favorite social media apps. Like, they say it's one of the less real places on the internet, and they a lot of people think Reddit's a meme stock, but this company is no meme. They have some of the most impressive growth I've ever seen. If we go to the revenue right here, like, this is why I take Reddit serious. The revenue's up 69%. After grew 71, after grew 25. Like, that's incredible growth at the bottom, these year-over-year growth rates. And they have no debt, so just a nice cherry on top is that they don't owe anyone any money. They have no debt at all. Now $3.14 billion of cash. They're retaining all this cash they're making. They did $250 million of net income this quarter. Like, that was a crazy beat, and they're expected to continue to, but like, no wonder people are taking Reddit serious. They beat like crazy on net income every quarter. So they're beating like crazy on net income. The expectations are up and to the right. They're beating on every metric, beating on revenue, beating on net income. Their ARPU, their average revenue per user, is like $5 now, and it's up 40% year over year. So they're making 40% more money per user than they were the same time last year. And it makes sense because it's reflected in the net income. And if we annualize this number, here's the cool part at this growth rate. Like, what's the net income going to be the same time next year? This quarter, they did 250 mil in net income. If we annualize that, that's $1 billion of net income. And the whole company is worth $28 billion. So they're trading, in my math, at a 28 forward PE. And remember, they have no debt and $3 billion of cash. You can almost subtract, and that's over 10% of the whole market cap. They have 3.15 billion of cash. So well over 10% of what you're paying is just their net cash on hand. So you can do an X cash PE multiple too. So Reddit, I do own. I'm totally biased, but I'm legit about to buy another share of them. I am still up 55% on them. I got 4 shares, but I love them. Yeah, they're licensing out their data to train LLMs too. Another interesting stream of revenue. Let's see. Oh, APPF. What's up, Monkey D. Luffy? Is that Appfolio? Yeah, I haven't looked at this stock in a really long time. Probably just caught in the software sell-off right now. Dang. Yeah, let's see what happened here. I remember them being profitable. So a 37 forward PE, so they are profitable with value-added services look at that annual growth. That's what you want to see for a growthy tech stock. So that's some nice annual growth. And they're also a subscription play. So they collect reoccurring subscription revenue. So let's check out the revenue. So the revenue's up 21% after grew 19. So if we zoom out, that's really good. Revenue's at a record. Oh, and no debt too. Pretty much no debt at all. No net debt. Fortress balance sheet. So the revenue's at a record. What about the profits? And the profits are, I think that's a record quarter. Let me zoom in just to double check. Yeah, this quarter they did 43 million of net income. I think that's a record. Yeah, never in a previous quarter before today had they make more. So they made the most amount of profits ever. The same quarter they did the most amount of revenue ever with a good balance sheet. How's the free cash flow over here? Yeah, free cash flow looks great if we zoom out here. So yeah, the past 2 years have really been extremely good for them. What's the expectations here? They beat like crazy. Yeah, so they expected 28 mil in net income. They did 39 mil. And they're supposed to be 36 mil, then 42 mil, which will be like 140 mil. Yeah, so honestly, I actually pretty like this name. 37 forward PE, not too shabby. Coinbase, yeah, Coinbase. This one's kind of cool. I think in the future they're going to decouple from Bitcoin. So Coinbase, if we kind of pull it up, let me add Bitcoin stock over it, or the price of Bitcoin over it. They don't move exactly, but they always like rhyme together. If the more I zoom in, it's kind of easier to tell. But Bitcoin and Coinbase always like really rhyme together and move very similarly. We zoom out here. Yeah, it looks almost perfect. So it's like a Bitcoin proxy, but I think they're going to decouple from Bitcoin and start doing better than Bitcoin because Coinbase actually just added in, well, I don't know if it's fully on the app yet, but they're adding in prediction markets and stock trading to Coinbase. So it's becoming like this all-in-one brokerage app, kind of like Robinhood, where you can buy stocks, buy your crypto, do prediction market contracts too. So they're being more than just a crypto platform. But here's a cool metric we get. So this is their monthly transacting users is 9.2 million. I guess the same time last year, it was 9.7 million. So it did go down slightly, but it's still a great metric. Monthly transacting users are 9.2 million. And how's the revenue growth or EBIT expectations? So what's the forward PE here? So net income wise, so Coinbase trades, they're saying at 39 times next year's net income. So the forward PE is actually slightly higher than the current PE. So that means the net income is actually supposed to be slightly lower next year than it is this year. So maybe that's why Coinbase is talking. But again, it really just is following what Bitcoin does. So it's kind of like financials are irrelevant. So it did say the revenue's down 21% year over year, but that's after it grew 140%. But anyway, the only reason I like Coinbase and I don't own them, I'd much rather own Robinhood before them and Futu, maybe Webull too. But I like that they're getting into prediction markets and stock trading. Well, that'll be just new streams for them to make more money. Is Berkshire Hathaway more like an ETF than a single stock? Absolutely. So you're right. Berkshire Hathaway is pretty much an alternative to the S&P 500. It normally does the same, if not slightly better than the S&P. Gives you like 8 to 10% of your money back every year. And yeah, it's an ETF in one because they own a bunch of businesses. You know, they own Geico. That's 27%. Well, before their investments in stocks, but this is their wholly owned businesses. Like they have a big stake in Apple and Coca-Cola and Moody's and a bunch of companies, but this is the companies they also fully own some businesses like Geico. If you heard of them before, big insurance company, they own Geico, they own the manufacturing, they own Pilot, the gas station, the truck station, they own BNSF Railroad, one of the best investments they've ever done. So yeah, it is like an ETF in one, and they don't pay dividends, but the way they return money is they do massive share buybacks. So that's the Warren Buffett. It was actually his last ever quarter as CEO. He just quit as CEO, but yeah, that's an S&P 500 alternative that's done very well historically. You should get just 8 to 10% of your money back a year, and that's great. That's why. So here's Serve Robotics. I'm not a big fan of these kind of startup robotics companies. Completes acquisition of Vibu over $3 million. So I guess they bought a company for $3 million. But yeah, if we go to the revenue right here, like it's just like, it's tough to trust this and like take them too serious. Like they don't, like they're in startup, like they have like no revenue. The revenue was 600,000 this quarter. And on the 600,000, they lost 33 million, the most amount of net income they've ever lost. So If you're looking for a real great robotics play to buy and never sell that will do great, I don't think that's the best one. Like I'd pick like a Symbiotic or an Amazon. Like Symbiotic is like the best purest robotics play. Amazon would be like the second best. So actually, let me do Symbiotic really quickly. Yeah, Netflix is a steal. Symbiotic, this is a warehouse robotics company. So that's where a lot of robotics are being really useful right now. And they help out Walmart with their logistics. And Walmart loves them so much because they're the largest customer. They love them so much that Walmart decided to buy their stock. Walmart owns 12% of all the shares, and that's just like reaffirming my confidence in them. But we saw Serve Robotic and Rich Tech Robotics, they had like no revenue, but look at this company. This one has over 1,500 registered IP and patents. They have crazy revenue growth. You know, the revenue's up 30%, after grew 35 at 620 mil of revenue. They made net income this quarter. And I actually want to pull up their website. Oh, I got to go in a minute here, but yeah, they have a really cool warehouse robotic system, and they have real revenue, real customers, real IP, real patents, and that's my favorite pure robotics play. So yeah, last up we'll do Netflix here, then I'll go. So Netflix, and by the way, I appreciate everyone that's here. If you wanted to follow button, we stream every Sunday, every day, but every Sunday at this exact same time. We've been live for over 2 hours and 20 minutes, so this has been fun. So yeah, Netflix, a huge beneficiary from advertising, and they're a subscription play. A lot of people, know Netflix, and they would cancel their Netflix subscription last if they had to cancel all their subscriptions. And it's an easy business model to understand. They have 301 million premium subscribers, so 301 million people paying for Netflix. And on average, it's a cool metric we get. Their average monthly revenue per paying membership is $11.69. And if we go to their bottom line, this is what's crazy. They keep, after paying taxes every quarter, easily $2.5 to $3 billion of net income. It's just insane. Ever since they introduced their ad subscription tier, their ARPU has gone up. But yeah, one thing that's hurting their valuation right now is this whole acquisition of Warner Bros. Discovery. As you know, they're trying to buy Warner Bros. Discovery for $72 billion, but also Paramount Skydance is trying to buy them for $103 billion. So actually, the more the price goes up, the more Netflix has to pay, the more decretive it is to their EPS. Like, it's already not accretive to the EPS, so it's going to be even more worse to their EPS. But whether or not they buy this company, and whether or not it gets approved by the DOJ, this is a great valuation. They're at like let's actually check the PE ratio. They're at a 24 forward PE, and it's a quality advertising name. So anyway, that wraps up the stream. I hope you guys have a great rest of your day. Hope you have a great rest of your Sunday. I appreciate everyone that's here. Again, hit the follow button if you want. Thank you. Best way to support me, if you wanted to support me, watch the stream from YouTube. You can watch it on the replay if you missed anything. I just made a video about a bunch of stocks I'm buying. I made it yesterday. So subscribe to my YouTube channel. It's called Nathan Roberts, and the link tree in my bio, very first link. You can just type into YouTube Nathan Robert. I'm streaming on YouTube and TikTok. I appreciate everyone on YouTube, because TikTok removed my stream from For You page eligibility, so it's kind of just cooked. But thank you everyone that's here. Shout out to King Chris, Tommy. Oh, my bad, I didn't get to ASML, but I do have to go sadly. Thank you, Tommy, Zero, David, Outwork, Mark, King Chris, 6-star, Michael Anthony, and for Aaron, if you're still here for the super chat. And I think Cruz, Cruz had a crazy super chat too. So anyway, hope you guys have a great rest of your day. I will see you.